Hello everyone. A very good morning to all of you. A quick confirmation. Can you please confirm with the audio and video is clear? A very good morning to all of you. Can you just give me a quick confirmation on whether the audio and video is clear? Okay, so welcome back to today's session. In yesterday's class, we had completed all the IND ASs. We were left with major topics, and our plan is to kind of get the major topics, including some of their important questions, out of the way today. So let us get started. We will start with share-based payments to start with. So in case of share-based payments, this is governed by IND AS 102. There are two major possibilities of share-based payment. It can be equity settled like an ESOP, or it can be cash settled like a share appreciation right or SAR. In case of an equity settled option, you will create an SBP reserve. In case of a cash settled option, you will create an SBP liability. In case of an equity settled option, the fair value will be determined on the grant date and you will do no further remeasurement. But in case of a cash option, fair value will be determined at each balance sheet date, and hence that makes it a little more tricky. Next, when we are looking at the valuation of few important terms like what is a grant date, vesting period, that is a period for which an employee has to stay in service in order to be entitled, and two values. One is fair value, one is intrinsic value. Fair value is calculated based on the expected prices using option pricing models. Intrinsic value is calculated as a market price minus the exercise price. Now, the timing of recognition and the amount of recognition. Timing, if the options are immediately vested, you will recognize the expense immediately. However, usually options come with the vesting period, and if there is a vesting period, you will spread this over the vesting period on a straight line basis. Measurement will be based on the fair value of the options or the shares, as the case may be, and it will not be based on the fair value of employee service. The journal entries over here will be over the vesting period. Your entry will be employee benefit expense account debit to SBP reserve. This employee benefit expense will be transferred to P&L. At the time of exercise, you will debit the bank for the exercise price, debit the SBP reserve to the extent of fair value on the grant date, to share capital, to securities premium. If the option lapses, you will take the SBP reserve to the retained earnings because it is an owner-to-owner transaction. If it is an SBP liability, on the other hand, all your workings remain the same, except instead of crediting SBP reserve, which is a part of other equity, you will credit SBP liability, which will be shown in current or non-current liability section. At the time of exercise, your entry will be SBP liability account debit to bank, and at the time of lapsing, it is SBP liability account debit to the statement of P&L. You need to remeasure the fair value at each balance sheet date if it is an SBP liability. In case of ESOP, you do not need to remeasure the liability at each balance sheet date. You will continue with the other equity item because own equity cannot be remeasured. While calculating the expense, in either case, you will take the number of employees which are expected till the end of vesting period into the options per employee into the fair value, either on the grant date in case of ESOP or on each balance sheet date in case of a share appreciation right. Okay. Next, we need to remember that in case of a cash settled plan like SAR, the remeasurement does not just continue during the vesting period. Even after the vesting period is completed, that is during the exercise period, you will continuously reassess and remeasure the SBP liability at fair value, and the fair value over here will be taken for the unexercised options because they are still outstanding. The standard covers also payments other than employees, in which case, if this is payment which is share based and it is for goods, you will recognize when the risk and reward of the goods is transferred. For services, you will recognize as and when service is rendered. In this case, the fair value will first be the fair value of the goods or services, and if that is not determinable, then the fair value of the shares issued. Next, an important accounting is for the group share-based payment plan, where parent issues shares in the SBP plan of the subsidiary, or subsidiary issues shares in the SBP plan of the parent. Then in the individual books, in the SFS, in the books of the parent, your entry will be investment in subsidiary account debit to SBP reserve. In the books of the subsidiary, investment is received, so that is capital contribution, which is shown in other equity. So that is employee benefit expense account debit to capital contribution, that will be appearing in the books of the parent. In the books of the subsidiary, you will have dividend distribution. Remember, parent invests in the subsidiary, subsidiary gives a return on investment, and as a result, in the books of the subsidiary, you will have, if subsidiary is issuing shares to the employees of the parent, it will be like a dividend distribution to the SBP reserve. In the books of the parent, it is employee benefit expense to a dividend income. So That is in case of a group share based payment plan. An important question, and which has also come recently, involves ESOP along with the cash alternative, where there is an equity or a cash option given to the employees. The standard over here says you will treat this entirely as if it is a cash plan with an equity option. So the fair value of the equity option can be calculated by taking the total fair value of the equity plan as on the grant date, comparing it with the fair value of the cash plan on the grant date. The difference between the two is the fair value of the equity option. Going forward, you will recognize the entire plan as if it is a cash plan, as if it is a share appreciation right, and additionally you will have equity option, just the equity option, which is the difference between the fair values as on the grant date, total fair values as on the grant date. That will be the value of the equity option, and that will be taken into the SBP reserve. So over here, your entry will be employee benefit expense account debit to SBP liability to the extent of the cash plan to SBP reserve. Okay. And then you will expense it off to the profit and loss account, the employee benefit expenses. Okay. During the exercise period, when the employees exercise, if the cash exercise happens, it is very clear, SBP liability account debit to bank to that's it. If there is an SBP reserve, you will transfer the SBP reserve to the retained earnings. It's like lapsing of the equity option. But if the option is exercised in equity, there are two alternatives. If you refer, I think the May 22 or November 22 suggested where this came, they have mentioned both the alternatives like what we have also covered. You can either transfer the SBP liability debit to share capital to securities premium and then pass a separate entry, SBP reserve account debit to retained earnings, or you can transfer the SBP reserve as a part of the same entry, SBP liability account debit okay, so you will, is it better now? Okay, so we were discussing in case there is an SBP liability, and the option is exercised in cash, your entry is SBP liability account debit to bank. But if the option is exercised in equity shares, then your entry is SBP liability account debit to equity share capital to securities premium. The rationale over here is the consideration for the shares issued is the liability foregone, and the balance in the SBP reserve is transferred to the retained earnings. An alternative as well as acceptable solution is to transfer this to the securities premium as well. So as a part of the share issue entry itself, you can pass the entry SBP liability account debit, SBP reserve account debit to equity share capital to securities premium. In the institute study material, they have transferred the SBP reserve to the retained earnings. But if you see the suggested answers, both alternatives are given. If possible, if it comes in the exam, follow the institute study material solution where you show SBP liability account debit to share capital to securities premium and transfer the SBP reserve to retained earnings. So there is no ambiguity. You follow the ICI's exact treatment. Okay. Then you have vesting conditions can be service linked, performance linked. Within performance conditions, there is market linked and non-market linked. If it is a non-market linked performance conditions, then at each balance sheet date, you will review the estimates of the possibility of vesting as well as the number of years. You will forecast the number of years it will take for the purpose of vesting and accordingly try to recognize the employee benefit expense. In case of a market linked performance condition, you will not review the estimates at each balance sheet date because fair value is determined on the grant date and the estimates are based on the market price as on estimates on the grant date. So you do not remeasure the estimates. Once you have the data on the grant date, if it is a market linked performance condition, you keep on recognizing the employee benefit expenses over the estimated vesting period irrespective of changes in actual estimates. Okay, next you have modification. If there is a subsequent modification in exercise price and if the modification is beneficial to the employee, you treat this modification as if it is a new plan. So your existing plan will continue to be accounted in the same way. The modification is treated to be a new plan and the incremental fair value on account of this modification will be spread over the remaining vesting period. Incremental fair value is calculated as the fair value of the modified plan minus the fair value of the original plan as on the date of modification. The difference between the two is the incremental fair value which you spread over the remaining vesting period. In case there is a cancellation, then in cases of cancellation, you will treat this as acceleration of vesting, where you will treat the vesting period to be shortened at the point of cancellation, and it will spread over whatever is the remaining EB in the year of cancellation. Second, cash compensation that you are going to pay will be segregated. The cash compensation will be segregated up to the fair value on the date of cancellation. You will treat this as an adjustment against SBP reserve. Excess, if any, will go to the P&L account. Now, the institute solution usually ends over here. However, additionally, there is some balance in the SBP reserve which you can transfer to the retained earnings if there is any balance. And last is, there is graded vesting, which also came, I think, in the in one of the recent RTPs. I think November 2022 RTPs. What was graded vesting? Graded vesting means if there is 100 options, out of which 20% are going to vest in the first year, 30% in the second year, 50% in the third year, in which case you will treat it as if there are 3 separate plans. First for 20 options, second for 30 options, and third for 50 options, and do the accounting for these 3 plans separately and do the working. So that kind of takes care of the concept level discussion for IND AS 102 share-based payment. We will try to go to the problems over here. So on your notes, you will go to, let us say, page number 114. So over here, page number 114 on share-based payment. So there are 3 or 4 problems over here. We'll quickly discuss them. So let us review them. So this is question number 1, which is on a cash plan where there is remeasurement based on intrinsic value, fair value, etc. A detailed video for this we have also put on YouTube separately. An entity which follows financial year as a calendar year grants 1000 share appreciation rights to each of its 40 management employees at 1st January. So this is 1000 options to 40 employees. SARS provides employees with the right to receive cash equal to the appreciation in the entity share price on the grant date. This is just explanation of what the SAR is. All rights vest on 31st December. So that's a 2-year vesting period, and they can be exercised during 17 and 18. So there is a 2-year exercise period. Management estimates at the grant date that the fair value of the SAR is 11 and estimates overall 10% of the employees to leave during the period. So out of the 40 employees, you are expecting 36 employees to continue. You are expecting 10% of them to leave. The fair values of SARs at each year end is given to you. These are the fair values. 10% of the employees actually left at the end of 16. On 31st March 17, that is after the vesting period, when the intrinsic value of each SAR was 10. So this is intrinsic value, which is equal to 10 over here. 6 employees exercise their options and remaining 30 employees exercised at the end of 2018 when the intrinsic value was equal to the fair value of 12. So there is an intrinsic value of 12. How much expense should be recorded? In this case, over here, it is a pure SAR plan, and hence you will take the number of employees, which is 36, expected till the end of vesting, into the options per employee, which is 1000, into the fair value. So you will take the fair value because it is a SAR plan. You will take the fair value at each balance sheet date. So into 12 and into 8, whatever number you get will be prorated 1/2, 2/2, and that will give you expense till date less earlier recorded, and hence you will recognize the employee benefit expenses for the first 2 years. So there is nothing tricky over here. This is 2,16,000 and 72,000. You will recognize EB account debit to SBP liability. Now the problem comes in the subsequent period. Now in your ledger, for example, you will have 36,000 into 8, that is 2,88,000 towards the SBP liability. Now this 2,88,000 is made up of 36 employees into 1000 into 8. Now when 6 employees exercise in the year 2017, when 6 employees exercise, they will be paid based on the intrinsic value. Remember, employee does not understand fair value, which is based on expected price. So they will be paid based on intrinsic value. So this will be SBP liability account debit. In your ledger, towards the 6 employees, there were 1000 options. In your ledger, they were worth 8. And hence, this comes to 6,000 into 8, which comes to, I guess, 48,000. However, what you will have to pay is based on intrinsic value. So to bank to the 6 employees into 1000, you will have to pay based on rupees 10, which is the intrinsic value. Let the fair value be something else. The payment will be paid based on intrinsic value. Is there a problem? Okay, so this will be, let us say, 6,000 into 10, which comes to 60,000, and hence if there is a balancing figure, that balancing figure of 12,000 will be recorded as a part of employee benefit expense. Now apart from this, the remaining options have not yet been exercised. They will be exercised in the future, and hence the relevant base for them will be the fair value, not the intrinsic value, because intrinsic value is only the settlement price of options that have been exercised. For the options that have not been exercised, it is likely they will be exercised in the future when the fair value will be, let us say, 13. So over here you will have to remeasure. So for the remaining 30 employees who have 1000 options, in your ledger you were shown this at 8 rupees. However, the revised value will be for 30 employees into 1000 options, the revised value will be 13. And as a result, this is what? 30,000 into 8, 2,40,000 in your ledger. You have to take it all the way up to 3,90,000. And as a result, there will be an increase, I guess, of 1,50,000, for which your again debit will be EB because this is likely to be paid to the employees. So this is 1,50,000 to SBP liability. Now once you do the third year, in my opinion 2017 is the most trickiest year over here. After this, when you go to the year 2018, the remaining employees exercise, in which case you will have something account debit to bank, and the payment over here is based on the intrinsic value, which is same as the fair value. So this is 30 into 1000 into 12 rupees is your fair value. So you are ultimately going to pay 3,60,000. However, your SBP liability in your books is 3,90,000, and hence the remaining 30,000, well, that will be treated as reversal of EB, which will be taken against in the profit and loss account. So this will be treated as reversal of EB going into the profit and loss account. Okay. So over here, when we do these workings, we will have, let us say, your EB getting recognized in the usual manner, and then 2017 is the important part where your settlement is based on the intrinsic value. Remember, ESOPs are settled, SARs are settled based on intrinsic value, but they are remeasured based on fair value. Okay, next you have question number 2, where there is an equity option with a cash alternative. So over here on 1st January, ABC gives options to its key management to take either cash equivalent to 1000 shares or actual 1500 shares. The minimum service requirement is 2 years and shares would be subject to lock-in of 3 years. The key management exercises a cash option at the end of 2012. You are required to pass journal entries, share alternative value, and then the other fair values are given. So what do we have to do? We first have to find the fair value as on the grant date. Fair value for the equity options will be 1500 into 102, and for the cash alternative will be 1000 into 113. So this is 1,13,000, and 1500 into 102 comes to 1,53,000, and as a result the equity option will carry a fair value of 40,000. As you see over here, equity option will carry a fair value of 40,000, which is the difference of the two. Once that is done, you will do the accounting for the cash plan in the usual manner, as if it is a pure cash plan, which means for the number of employees, let us say 1 employee into, let us say 1000 cash equivalent items into 1000 into the fair value at each balance sheet date. So you will take 120 as well as 132. So if you see the workings, 1 into 1000 into 120 and 132. So this will be prorated, and 60 and 72,000 ka expense will be recorded. This is on a pure cash. However, there is also an additional add-on top up like an equity option, and that is worth 40,000, which will be recorded 2020 in the first 2 years, 20,000, 20,000. So your entry will be EB account debit 60,000 plus 20,000, that is 80,000, to SBP liability to SBP reserve. So this will be your EB for the first year, then EB for the second year. Now if the cash option is exercised, the balance in the SBP liability is actually 1,32,000. Your entry will be SBP liability account debit 1,32,000 to bank 1,32,000. On exercise, you will have SBP liability account debit to bank. However, there is a balance of 40,000 in the SBP reserve, which will be transferred to the retained earnings. If there was an equity settlement, you could have said SBP liability account debit to share capital to securities premium, and then the balancing figure, if any, separately for SBP reserve 40,000 will be transferred to retained earnings. So over here, this is an extra working which we have also done. Achha, so that is question 2. Then we have question number 3. I think यहाँ पे numbering में थोड़ा गड़बड़ हो गया. That's fine. So you look at question number 3, which is, this is actually 3, which is on performance conditions. So over here, it's a fairly detailed problem. So over here, you have performance conditions which are non-market linked. So if we see enterprise grants 100 options to 500 employees, conditional upon they remaining in employment during the vesting period. Options would vest at the end of year 1 if earnings increase by 18, year 2 if they increase by average 13 over 2-year period, year 3 if they increase by 10% over the 3-year period, and fair value is 30. So this is earning linked. It is linked to you having to remain in service plus you having to get an earnings growth. So it is not a market linked condition. At the end of year 1, earnings increase by 40%, 30 employees left. Enterprise expects that the earnings will continue to increase at the same rate in year 2 and options would vest at the end of year 2. So we are expecting an average earnings growth of 14%, options likely to vest at the end of the second year, and hence the working in the first year will be based on an estimated vesting period of 2 years. You are estimating the vesting period to be 2 years. The enterprise expects a further 30 employees to leave during year 2 and therefore expects options would vest in 440 employees. So there will be 440 employees which are likely to remain till the end of year 2. So when you do the working, your working will be 440 employees into 100 into 30. This will be prorated over 2 years because it is a non-market linked performance condition. So you can look at the estimates. And 6,60,000. When you go to the second year, you see earnings have actually increased by 10% and hence options do not vest because it does not meet the target. Question gives you that. 28 employees have left. The enterprise expects a further 25 employees will leave during year 3. And the earnings of the enterprise will increase by at least 6%, thereby achieving the average of 10%, which means the likely vesting period you expect is going to be 3 years. There is no vesting in the second year. And the number of employees are, there were 500, out of which 30 have left in the first year. 28 have left in the second year, and you expect a further 25 to leave. And as a result, this is what? This is 417. So these options will vest in 417 employees and the vesting period will be 3 years. So if you look at 417 employees and you do a 2 by 3, your vesting period kind of changes. You do a 2 by 3 adjustment. And last month 23 employees have left. The earnings have increased by 8%, resulting in a 10.67% growth. And 419 employees. So you see actual vesting happens, which means 419 employees, 100 options per employee into fair value, and this will be prorated 3 by 3. So what I'm trying to say is the vesting period can potentially change because it is a non-market linked performance condition. In case of a market linked performance condition, the vesting period that is determined as on the grant date will usually continue to remain. Are we clear with this? Chalo. Is it clear now? Okay. So we'll just wrap up this last question. This is on ESOP modification. So this is on modification. When we look at modification, we look at the incremental fair value calculation as well. So earlier on 1st April 11, there were 1000 share options given to 2000 employees. The options are due to vest on 31st March 14. So that's a 3-year vesting period. Provided employees remain in employment. On 1st April 11, the directors estimated that 1st April is a grant date. Estimated 1800 employees would qualify. So out of 2000, maybe 200 will leave. The estimate was amended to 1850 employees on 31st March 12 and further amended to 1840 employees on 31st March 13. So this is the estimate of number of employees. As on 1st April 11, the fair value of the option was 1.2. This is on the grant date. The fair value increased to 1.3 as on 31st March 12. So this is share options, not share appreciation rights, and hence these options will be at the fair value on grant date only. But due to challenging conditions, fair value declined thereafter. In September 12, the fair value of the option was 0.9. Let it be 0.9. The directors repriced the option and caused the fair value to increase to 1.05. So due to the repricing, the fair value which was 0.9 went up to 1.05 and hence 0.15 will be the incremental fair value. Trading conditions improved in the second half and the fair value of the option was 1.25. This does not matter. So basically what do we have to do? You have to show the accounting on 31st March 2013. There are two plans. One, there is the existing plan. The existing plan you will continue to recognize based on the fair value as on the grant date, which is 1.2, and then there is a new plan. So fair value on the grant date was 1.2. At year 1, you will have 1850 employees which are expected to continue. 1800 was on the grant date, but at the end of the year, this is 1850 employees. At year 2 end, you are estimating 1840 employees into the options per employee. There are 1000 options per employee. into the fair value. Remember, the fair value over here will be the fair value as on the grant date only. In other problems, you were remeasuring the fair value because it was it had a cash plan. There is no cash plan over here, and hence you will prorate it 1/3, 2/3, and then 3/3. However, on modification, there is an incremental fair value of 0.15, and this happens. There's nothing in the first year. In the second year also, the vesting period over here is 1.5 years. The vesting period is 1.5 years, and hence when we are looking at the modification over here, the number of employees, let us say, in year 1 you don't take anything. In year 2 you had a new plan which came in from 30th September 2012 and continues up to 31st March 2014. So that is around 1.5 years. Into 1000 into the incremental fair value of 0.15, whatever number you get, you spread it over 0.5 years out of 1.5 years. So you have to be careful in calculating the incremental fair value, that is 0.15, and then spread it over the remaining vesting period. The remaining vesting period is 6 months out of 18 months or half a year out of 1.5 years. So these are the two things you have to be careful. First, you will take 1.2 and 1.2. This is for the original plan, and then for the new plan, you will take the fair value, which is the incremental fair value, and spread over the remaining vesting period. So this takes care of share-based payments. Next, you go to financial instruments. Now, this is kind of the heart of IND AS, Institute's absolute darling and favorite. So this is a very, very important topic. We'll quickly run through the important facets of this and then do the necessary topics. Deferred tax linked with share-based payment. We discussed this yesterday in IND AS 12 session. There are 3 rules that you have to remember. First, the carrying value will be nil because the carrying value is based on the fair value. Second, you look at the tax base, which is based on the intrinsic value, which is prorated, and then the difference between the two into the tax rate will always create a deferred tax asset. 3 steps you refer IND AS 12. Okay, so we look at financial instruments. Within financial instruments, there is a financial asset, which among other things will be cash, equity investments, another entity, contractual right to receive cash, and if there is settlement in own equity instruments, it has to meet the fixed to fixed test. Similar case for financial liability, contractual obligation to deliver cash, and if the settlement is happening for a variable number of own instruments, it will be financial liability. If it happens for a fixed number of own equity instruments, it will be equity. Equity over here, it will be any instrument which evidences residual interest. So in this case, there are a lot of examples and a lot of cases. 2 important cases which stand out particularly will be in case of a preferential or debenture issued. You look at the distribution feature, you look at the redemption feature and conversion feature and figure out whether it is a liability, equity or a compound financial instrument. And in case of commodity derivatives, if they are gross settled, there is something called as an own use exemption, in which case IND AS 109 will not apply. But in other commodity derivatives which are net settled, then IND AS 109 can potentially apply. Next, you go to the classification. Within classification, financial assets have 3 subparts: amortized cost, FVOCI and FVTPL. Within amortized cost, you typically take instruments which are debt instruments which are intended to be held till maturity. Under FVOCI, you take debt instruments which are intended to be sold before maturity. Hello, can you please confirm if the audio and video is clear? Okay, chalo. Good afternoon everyone, and hopefully with the grace of God and everyone, we should be on track for this session. So we were discussing about financial instruments. Let me just continue from where we left. I guess we faced some issue and we had to drop off at classification of financial instruments. We discussed about the initial financial asset or liability. When we discuss classification of financial instruments, it can be financial asset which can be classified at amortized cost, FVOCI or FVTPL. Usually financial assets which are intended to be held till maturity and financial assets. So usually financial assets which are held to maturity are to be shown under the amortized cost principles. If there are financial assets which are intended to be sold before maturity, which are debt in nature as well, which will be FVOCI. Everything else by default is usually FVTPL. Specifically derivatives, held for trading items and financial assets designated FVTPL should be taken. For equity shares, there is a choice of either you showing it as FVTPL or a one-time irrevocable unconditional choice to show it within FVOCI, for which there are two tests, the CCFC and business model test, which will be done to see whether a particular instrument should be under amortized cost or under FVOCI. Next, you go to the accounting for financial assets, which I would rate as very important. The initial recognition of financial assets happen at fair value. Now, usually transactions are assumed to happen at market terms, in which case transaction price is the fair value. What are transactions at market terms? Which means in a particular transactions, apart from the pure lending and investing, there is no other element. There is no other hidden element like employee benefits, no other hidden element like lease or nothing else. So if the transaction is at market terms, initial recognition will be at fair value, which is the same as transaction price. If there's a transaction cost, then the transaction cost will be added to the initial recognition value in case of amortized cost and FVOCI. However, in FVTPL, the transaction cost goes to the P&L. At every subsequent balance sheet under amortized cost method, the asset will be shown at amortized cost, and under FVOCI, FVTPL will be shown at fair value. Unrealized gains will not arise under the amortized cost method, and under FVOCI, it will go to the fair value reserve as a part of OCI. Under FVTPL, it will go to the profit and loss. At the time of realization of gains or losses under amortized cost, it is rare, but if it happens, it will go to the P&L. Under FVOCI debt, it will be transferred to the statement of P&L. So the balance in the fair value reserve will be transferred to the statement of P&L. And under FVOCI equity, the balance in the fair value reserve will be transferred to retained earnings because it is a non-reclassifiable OCI. In case there is interest is to be recognized using the effective interest method, and using effective interest method, the interest will be recognized in the profit and loss account. In both FVOCI as well as amortized cost, in FVTPL, you will recognize based on the agreed interest or dividend in the profit and loss. Under the effective interest method, you will calculate the real rate or the effective rate using the IRR method, and your effective interest will be the opening balance into the effective interest rate, which will be added to the opening balance, minus the coupon or principal paid will be subtracted in order to find the closing balance. Ultimately, at the end, the amortized cost will go down to the redemption value or to a nil value if it is fully paid off. While looking at initial recognition, if the transaction is off market, that is, there is a hidden employee benefit, a hidden investment in the subsidiary, a hidden lease right of use asset, a hidden grant, in all of these cases, initial recognition will be done by calculating fair value separately, which is calculated as a present value of future cash flows, taking market rate of a similar instrument as the present value. Next, we look at financial liabilities. Usually within financial liabilities, there are 6 liabilities which is under FVTPL, everything is under amortized cost, which include derivatives, FVTPL, designated items, held for trading items, financial guarantees, contingent consideration, continuing involvement liabilities will all be taken at fair value. Every other liability will go at amortized cost method. Within accounting for liabilities, the working is exactly the same as that of assets, except for the fact that transaction cost, if any, under amortized cost method will be reduced from the fair value rather than it being added like you do for assets. Transaction cost will be reduced. Loans which are repayable on demand will be measured using fair value only. So fair value will be transaction price if the loan is repayable on demand. In case of certain off-market transactions, common transactions include employer-employee, where the balancing figure is like staff welfare or employee benefit expense, landlord-tenant, where the balancing figure is like the right of use asset, government entity, the balancing figure is grant and accounted for as per IND AS 20. In case of parent subsidiary, if parent is lending to the subsidiary, it is investment in the books of parent, capital contribution in the books of subsidiary. Subsidiary lending to the parent interest free, then it will be like a distribution to the parent, and the hidden element will be taken as dividend income in the books of the parent and distribution in the books of the subsidiary. Own equity cannot be remeasured, and hence it will be recognized at value at initial recognition. There will be no no remeasurement over here. However, if there's transaction cost, then the transaction cost for a fresh issue of equity shares will be reduced from equity, whereas if it is transaction cost on equity shares which are already there, then the transaction cost will be taken into the profit and loss account. Okay, so reclassification is extremely rare, is possible in case of financial assets if there is a change in business model. Within financial liabilities, reclassification is not permitted. Within equity, there is no different head to kind of reclassify. Okay. Then you go to compound financial instruments, which is very important. When you look at compound financial instruments, notably convertible instruments, whether it is compulsory or optionally convertible, you will first try to find the liability component based on the present value of future cash flows, which are in the nature of liabilities, discounted at the market rate of interest on similar instruments without conversion option. The balancing figure over here will be taken into the hello. Okay. So we were discussing about compound financial instruments within which if there is a liability component, then under liability component there will be present value of future cash flows which are in the nature of liability, discounted at the rate of interest of similar non-convertible instruments. The balancing figure is treated as the equity component. Journal entry is bank account debit to liability component to equity component. That will be the entry. Subsequently, liability component will change as per the amortized cost method, whereas equity component will remain the same. Equity component will not change. At the end, in case of compulsorily convertible instruments, there will be no liability component. So your entry at the time of issue will be equity component account debit to share capital to securities premium. In case of optionally convertible instruments, there will be both liability and equity component. If redemption is asked, then liability component account debit to bank, equity component transfer to retained earnings. If fresh issue is done, then liability component account debit, equity component account debit to share capital to securities premium is the entry that the institute usually passes. Over here, if there is transaction cost in case of a compound financial instruments, transaction cost is attributable to both liability as well as equity component, and hence you will separate the transaction cost from the liability as well as the equity component both. In case of early redemption, one needs to be careful in splitting the early redemption price between the liability and the equity component and then finding the gain or loss. If there's a gain or loss on the liability component, it goes to the P&L. If it's a gain or loss on the equity component, we directly take it to the retained earnings. Next, you have certain regular way contracts, which are contracts which in the regular way are settled. Regular way contracts can be in the nature of shares that you buy, let us say on the stock exchange, which is settled on, let us say, a T+2 basis, in which case two types of accountings, that is trade date or settlement date, is possible. Trade date accounting would refer to accounting when the trade happens, whereas settlement date accounting refers to the accounting when the settlement, that is the share, comes or goes out of your demat account. A few special cases are also there, and then you have derivatives. Derivatives over here are to be accounted for using FVTPL principles, and if it is a derivative financial asset or a derivative financial liability, it will be recorded using FVTPL principle. Only if it is a derivative own equity item, then it will be recorded at the value at initial recognition. There is something called as embedded derivatives, which are derivatives which are inbuilt into the regular financial instrument. Here, if there is an embedded derivative into a host financial asset, no separation is needed. But if there is an embedded derivative in a financial liability, equity, or even a non-financial item, in such cases you will have to do separation. And when you kind of do this separation, you will take the when you kind of do this separation, you will try to separate if the economic characteristics of the host contract and the embedded derivative are different. If economic characteristics are not different, then separation is not needed. Two special cases are there where there is a prepayment option inside a loan, where loan is taken, in which case you will calculate the value had there been no prepayment option, compare the amortized cost with the prepayment price, and if they are not closely related, that is the differences are not approximately equal, in which case you will do the separation. Second is there is a foreign currency transaction. So over here, if there is a foreign currency purchase or a foreign currency sale, it is possible that there can be a foreign currency derivative embedded over here. In this case, what you will try to do is you will have to separate the contract into two parts. One is a pure purchase and second is a payment of dollars. So payment of dollars is like a sale of dollar and hence forward sale, and you will do the working separately for purchase as per IND AS 2 and for the forward sale as per IND AS 109. While doing so, one needs to know that this separation is only done if the contract is in a currency which is different from the currencies of the parties to the contract. The contract is in a currency which is not usually traded between the two parties, or it is in a currency which is not common as compared to the currencies which are commonly used for the purpose of this asset. Okay. Derecognition of financial assets is happening when the risk and reward, that is the control of the financial asset, is transferred, not necessarily because you are selling the asset. The control over the cash flows have to be transferred. I would not put a lot of weight behind derecognition of financial assets, though derecognition of financial liabilities has a very important case which involves substantial modification or extinguishment. So if there is a financial liability, you will typically derecognize a financial liability once it is discharged. However, in certain special cases, if there is a major restructuring of the financial liability, you will have to see whether there is extinguishment accounting or modification accounting which can potentially become applicable. So when you are looking at extinguishment accounting, you will try to calculate the difference between the present value of the modified cash flows at the old DIR and the current carrying value. If the percentage is greater than 10%, then there's a substantial modification. In case of substantial modification, you will derecognize the old loan and then create a new loan. The difference, if any, will go to the profit and loss as gain or loss on extinguishment. However, if the difference is less than 10%, then you will modify the existing loan. Either you will modify the ledger balance, or you will modify the EIR in order to account for this derecognition. That is slightly important. Then you have impairment. Impairment arises in case of a financial assets which are usually recorded using amortized cost or FVOCI principles. There is no impairment in equity because there are no contractual cash flows. Under impairment, there is an expected credit loss or ECL model where assets are subclassified into three stages: stage 1, stage 2, stage 3. In stage 1, you will create a provision based on the expected credit losses based on 12-month expectations. Again, for stage 2, where there is a significant increase in credit risk, you will do a lifetime probability of default, and in stage 3 the assets become credit impaired, in which case also you will do a lifetime probability of default for the purpose of expected credit risk. You have the accounting for financial guarantee, which was recently asked in the exams. So under the financial guarantees, you will treat financial guarantee as a financial liability and account as per FVTPL. While you are trying to find the fair value, for determination of fair value, you will take the present value of the future benefits which are attributable to guarantee. How do you find the benefits? For example, if without the guarantee, a borrower could have taken the loan at 11%, with the guarantee the borrower is taking the loan at 8%, then the difference of 3% is the benefit attributable to the guarantee. So the present value of all the savings will be the benefit attributable to the guarantee. Compare that with the loss allowance and select whichever is higher. That is, how much will be the loss on account of the guarantee. The present value of the benefits attributable to guarantee and loss allowance, whichever is greater, is to be found, and that will be the value of the guarantee. The differences in the fair value, if any, will be taken to the profit and loss account. Hedge accounting, not very important. There are three types of hedges. Again, hedge accounting is optional. One is a fair value hedge, one is a cash flow hedge, and one is a hedge of net investment in a foreign operation. In case of a fair value hedge, the gains or losses on the derivative as well as the underlying asset will usually be taken to the P&L unless the hedged item is investment in equity shares at FVOCI. In case of a cash flow hedge, the gain or loss on the derivative will be kept in the hedging reserve as a part of OCI till the time the cash flow actually goes to the P&L, in which case the hedging reserve will also go to the P&L. And in case of net investment in a foreign operation, again, the gain or loss on the foreign operation is in FCTR OCI. So the corresponding hedge will also be kept in OCI till the time FCTR gets transferred to the P&L. So this is a quick overview of the financial instruments. We will go to the questions over here. Let us go to page number 122 where we try to address the questions. Chalo. As a part of staff welfare measures, so this is amortized cost practice. As a part of staff welfare measures, Y contracted to lend to its employees sum of money at 5% per annum. The amount lends are repaid along with interest in 5 equal installments of principal. Okay, and interest needs to be paid annually along with each installment. The rate of interest is 10% for comparable loans. So this shows that the loan is off market. Again, it is not just a pure lending of 16 lakh rupees. It is a pure lending as a part of staff welfare measures, and hence there is some hidden other element involved as well. Y lent 16 lakhs to its employees on 1st January. The following the principles of recognition and measurement as per IND AS 109, you are required to record the entries for the year ended 31st December. Also compute the value of the loan at initial recognition and amortized cost for each year. So what will we do? We will first have to figure out. So the thought process over here is you first have to ask yourself that accounting is in whose books? It is in the books of Y, for whom it is a financial asset because you have a contractual right to receive cash. And say if it is a financial asset, it is classified at amortized cost. So over here, this is financial asset which is to be shown at amortized cost, and this is a transaction which is off market, and hence at initial recognition you will have to find the fair value. Fair value is calculated as the present value of future cash flows, and future cash flows which are agreed to be paid by the employee is 16 lakhs divided by 5, that is 3 lakh 20 each year for the principal. Apart from that, interest is on the outstanding principal, so 16 lakhs into 5%, that is equal to 80,000 in the first year. In the second year, principal is repaid, and as a result the outstanding principal into 5%, and you will keep on finding the interest. So your interest will keep on falling, and hence you will find the total cash inflows. These total cash inflows are to be discounted at 10% because that is a comparable rate. So over here at the rate of 10%, what is the present value? Well, the present value will be 14,06,272. So the loan initially will be recognized at 14,06,272, against which a payment of 16 lakhs will be made, and hence the remaining 1,33,93 will be shown as prepaid employee benefit expense. This will be spread over the 5-year period. If nothing is given, we'll assume that the employee has to render 5 years of service to be entitled to this benefit, and hence you will spread this over the 5-year period. So over here, this is the important journal entry: loan, prepaid staff welfare to bank, and then this prepaid staff welfare will be spread to the P&L over a period of 5 years. You can prepare amortization table where you start at 14,06,272, recognize effective interest at the rate of 10%, and ultimately you come down to a zero value. Okay, next we have question number 2, which is also loan at off market rates. The two most important things over here is loan at off market rates and compound financial instruments, in which case there's a loan. KK has granted an interest free loan of 10 lakhs to its wholly owned Indian subsidiary YK. So KK is the parent, YK is the subsidiary. Loan is 10 lakhs which is interest free, that is a 0% interest. There is no transaction cost attached to the said loan. The company has not finalize any terms including applicable interest. The board is evaluating various options and requested your firm to provide your views. If the loan provided by KK to its wholly owned subsidiary is interest free and this loan is repayable on demand. Remember, when the loans are repayable on demand, IND AS 113 tells you that the fair value equals to the transaction price. You don't have to do the present value of future cash flows because the loan is repayable on demand. So if I give you 10 lakhs today, I have a contractual right to receive 10 lakhs immediately. The other party is under an obligation to pay 10 lakhs immediately. And hence, fair value is equal to the transaction price, that is 10 lakhs. Your journal entry in the books of the lender will be loan account debit to bank 10 lakhs. In the books of the borrower, bank account debit to loan 10 lakhs. There will be no other effective interest. Second, the said loan is interest free and repayable after 3 years. So this is now a term loan. From the date of granting such loan, the current market rate of interest is 10%, and considering the same, the fair value is 7,51,000. In which case, the journal entry will be loan account debit 7,51,000 to bank. We are paying 10 lakhs, and hence the balancing figure approximately 2,49,000 will be taken as investment done by the parent in the subsidiary. It is a transaction between parent and the subsidiary, so this balancing figure will be shown as investment in the books of KK. Similarly, YK, which is as well subsidiary, is receiving that investment, and hence YK will pass entry bank account debit 10 lakhs to loan 7,51,000. Balancing figure will be shown as capital contribution from the parent, which will be a part of other equity. Okay. Third, the said loan is interest free and will be repaid as and when YK has the funds to repay the loan. So if this is to be repaid as and when YK has the funds to repay, this is also a term loan. It is not repayable on demand. It is a term loan where YK will repay when YK has sufficient funds, and hence you will have to forecast the period which YK expects to generate those sufficient funds and accordingly recognize recognize the journal entries. Based on the same, KK has requested you to suggest accounting treatment that you have done. Further, company is also planning to grant interest-free loan from YK to KK. So it's the other way around. If YK is granting to KK, then the balancing figure, instead of being shown as investment and capital contribution, will be shown as dividend distribution and dividend receipt. So this is also an important question. Next, you have question number 3, which is a 2-time exam question. All of these questions have come in the exam. This is a loan which is given off market terms, and then there is a prepayment which is done by the employee. Wheel company has a policy of providing subsidized loans to its employees for the purpose of buying or building houses. Mr. X, who is executive assistant to the CEO of Wheel, took a loan from the company on the following terms. So the principal amount, interest rates are different, 4% for the first 4 lakhs, 7% for the next 6 lakhs. Start date is 1st of January, term is 5 years. Prepayment, full or partial prepayment at the option of the employee. If the employee wants, employee can prepay. The principal amount of the loan shall be recovered in 5 equal installments and will be first applied to 7% interest bearing principal. So the principal will be repaid in 5 equal installments. So if it is 10 lakhs divided by 5, that is 2 lakhs each year, and will first be applied to the 7% interest bearing principal. Accrued interest must be paid on an annual basis. X must remain in service till the term of the loan ends. So if there's a hidden prepaid employee benefit expenses, it will be spread over 5 years. The market rate of a comparable loan available to Mr. X is 12%. Okay, so is this transaction at market or off market? Well, it seems to be off market, because as a part of the staff welfare measures, you have given a loan at a concessional interest of 4 or 7% when the market rate of interest is 12%, and hence the first step over here is to find the fair value. Fair value is the present value of future cash flows, considering the contractually expected cash flows to be, let us say, total principal cash flow, interest cash flow, principal cash flow, interest cash flow. So you will total all of these numbers and you will get the cash flows in each year. So for example, this is 2 lakh 58,000. This is 2 lakh 44,000. This is 2 lakh 30,000, and so on. And you will discount this at the rate of 12% to find the present value. Acha. So first thing is you find the fair value of the loan at initial recognition, which is the present value of future cash flows. So you will find the future cash flows, total cash flow 258, 244, 230, and so on. And you will discount it at the rate of 12% in order to find the present value of the future cash flows, which comes to approximately 8,43,000. So the balancing figure will be prepaid employee benefit expense, and this prepaid employee benefit expense will be prorated over a period of 5 years. Acha, what happens further? Mr. S prepays 2 lakhs on 31st December 12th. So that is after 2 years. So for 2 years, the amortized cost working will continue. 8,43,000 will be amortized plus EIR at the rate of 12%, minus coupon paid, minus 2 lakhs of principal closing, again plus EIR of 12%, minus coupon, minus principal, and you will get the value at the end of the second year. This will be the loan balance. Now 2 lakhs is repaid. So if 2 lakhs is repaid, we are getting money, bank account debit 2, you will credit the loan. Now someone will say we will credit the loan by 2 lakhs. That is incorrect. You will try to find the value of the loan based on the present value of the remaining cash flows. So what you will do is you will try to find the present value of the remaining cash flows, and based on that you will try to find the value of the loan. Compare that with the existing balance, and the difference will be taken as the repayment. So what will happen over here is following table shows the actual cash flows from the loan given to Mr. X considering the prepayment event in 31st December. So in the first year you have paid 2,48,000 barabar. Second year you have paid 4 lakhs plus 28 plus 16, and then the remaining cash flows, if you go to see, are only 2,16,000 and 2,08,000. So we will say that after the prepayment, what is the value of the loan? So you will discount 2,16,000 and 2,08,000 at the rate of 12%, and you will say that after the prepayment, what is the present value of the remaining cash flows? That is the value of the loan after the prepayment. Compare it with the existing ledger balance. So when you are going to show the prepayment, the difference between these two. So over here, let us say the revised carrying value of the loan based on 2,16,000 and 2,08,000 is 3,58,000. So after prepayment, 3,58,000 should appear in your ledger. However, when we look at your ledger balance, currently it is 5,25,825, and hence the difference between the two is to be adjusted against the loan. So if I take the difference between these two, 525, 610 and 358 684. The difference between the two, that is 1,66,000, is a reduction in the loan balance. 166 926 is a reduction in the loan balance, but the employee is paying 2 lakhs and hence the balancing figure will be adjusted against prepaid EB because employee का additional उतना welfare नहीं होगा. Earlier we thought 5 years के लिए welfare होगा, but the employee has paid 2 lakhs in advance and hence the welfare will happen only for 4 years and hence the remaining will go against prepaid EB. This is the important entry in this question. Bank account debit 2 lakhs for the prepayment. Loan account debit, this is the difference between the two ledger balance. One, the existing ledger balance before prepayment, and second, what should be the modified ledger balance after considering the prepayment. So this is 1,66,000 and then the balancing figure is adjusted against the prepaid EB. After that, all the other entries continue to remain the same. The remaining prepaid EB will be spread over the remaining 2 years. Okay, next you have question number 4, which is compound financial instruments. So this is ABC issued 10,000 compulsorily convertible cumulative preference shares as on 1st April at 150 each. So it is 10,000 into 150, issue price will be 15 lakhs. The rate of dividend is 10% payable each year and the preference shares are convertible into 5,000 equity shares of the company at the end of the 5th year from the date of allotment. So they are convertible into a fixed number of entities' own equity instruments. When the CCPS are issued, the prevailing market rate of interest for similar debt without conversion option is 15%. Okay, so you have that without the conversion option. So this will help you to find the liability and the equity component. Transaction cost on the date of issuance is 2% of the issue proceeds. So key terms, face value is 150, face value of equity shares after conversion is 10 and effective interest rate is 15.86. You are required to compute the liability and equity component and pass the journal entries for the entire term of the arrangement. So over here, your total issue proceeds, let us say, are 15 lakhs. Out of 15 lakhs, there is still a transaction cost, remember. There is 15 lakhs, but there are transaction costs. You will compare the liability component. 15 lakhs into 10%, that is 1,50,000. You are under a contractual obligation to pay 1,50,000 for a period of 5 years. So if you take the present value at the rate of 15% for a period of 5 years, you will probably get into 3.3521 or 22. This will give you the liability component. So this is into 1,50,000 comes to approximately 5,02,823. This will give you the liability component and hence the remaining will be the equity component. So over here, the remaining 9 lakh, 15 lakhs minus 502,823, which is 9 lakh. 97,177 will be the equity component. Remember, there's a transaction cost. Transaction cost is 2% of what? Well, of the entire proceeds, and hence you will subtract minus 2% and minus 2% from each of these in order to find the equity component after transaction cost, which is 9,77,233 and minus 2%. This is 5,02,823 minus 2%, which comes to 490,767. This is the liability component. Remember, your entry will be bank account debit 14,70,000, which is after 2% transaction cost, to liability component 4,92,767, to equity component 977,232. We have not taken the principal component in the liability calculation because it is a compulsorily convertible instrument, in which case you have no obligation to pay the 15 lakhs back, and hence this will be your journal entry. Going forward, 4,92,767 will be accounted based on the effective interest rate at 15.86%, which is given to you. So 4,92,000 will ultimately be accounted for over a period of 5 years, and it will come down to a zero value at the rate of 15.86%. Equity component will remain as it is, and there will be an issue. Equity component account debit 9,77,000 to share capital to securities premium. Okay, so over here, to start with, the first entry will be bank account debit 1470 to liability component to equity component. Then at 15.86%, you will recognize the effective interest and show the workings, and accordingly you will pass the journal entries for each of these years. Next we have question number 5, which is also on compound financial instruments involving an early redemption. So over here, on 1st April, Shelter issued 5,000 8% convertible debentures with a face value of ₹100 each, maturing on 31st March 19. So it's a 5-year tenure. The debentures are convertible into equity shares at the option of the holder. Okay, so these are convertible at the holder's choice at a conversion price of ₹105. Let the conversion price be 105. It is not the redemption price. So these are optionally convertible instruments. In case holder does not convert till 31st March 19, redemption would happen at par. Interest is payable annually in cash. At the date of issue, shelter would have issued non-convertible debt with a 5-year term bearing coupon rate of 12%. Okay, so over here, if I had to find the liability component and the equity component, what I would do is I would take the cash flows at the rate of 8%. So 5 lakh is my face value. 5 lakh into 8% comes to 40,000. So at initial recognition, 40,000 into the PVAF at the rate of 12%, which was the rate for a period of 5 years. Because it is optionally convertible, I will also take the principal because I have an obligation to pay at the rate of 12% for the 5th year, and you will get some liability component which is approximately 4,27,000 or 4,27,700, and hence the remaining 72,300 will be equity component. This is very standard question involving optionally convertible instruments at initial recognition. Now 72,300 will not change, whereas for 4,27,700 you will follow the amortized cost working. 3 years later, if you read the question, early redemption has been agreed at 5,25,000. So how will you account for that? Well, that 5,25,000 settles the equity component as well as the liability component, and hence you have to figure out how much of this 5,25,000 is attributable to liability component, how much of it is attributable to equity component. So at early redemption, whatever is the 5,25,000, you will split into the liability component and the equity component. Now within the liability component, you will try to find the present value of the remaining cash flows. There were 5 years. Out of 5 years, 2 years have gone by, 3 years are remaining, and hence, out of the 5 years, 3 years have gone by, 2 years are remaining, and hence you will try to find the present value of this instrument for the remaining 2 years. And that comes to 4,91,000. So ideally, out of 5,25,000, we believe 4,91,000 is paid for the liability component, and hence the remaining 33,000 is paid for the equity component. So you will pass 2 separate entries. First for settling the liability component, then for settling the equity component. So liability component account debit, it will be debited by what is there in your ledger. So in your ledger, you will calculate the amortized cost and say 4,65,000 appears in your ledger. So 4,65,000 will be debited to bank. 4,91,000 will be paid, and balancing figure, because it is settlement of liability, will go to the P&L. Secondly, settlement of equity component, where you will debit the equity component by 72,300, which is there in your ledger, credited by bank by 33,000. Difference will be the gain, which will go to retained earnings because it is equity in nature. Acha, if the question does not mention anything, whether it is compulsorily convertible or optionally convertible, first you have to look at various hints which are given in the question. So if the question gives you a hint that the instrument is early redeemed, remember, a compulsorily convertible debenture cannot be early redeemed. For you to early redeem something, it has to be redeemable in the first place. So if it's an early redemption question, it has to be an optionally convertible question only. Secondly, if the question does not mention anything about optionally or compulsorily convertible, however, the question somewhere tells you that the holders have exercised their choice of conversion. Let's say in one of the questions which had come recently, they had said at the end in the third subpart that the holders exercise their choice of conversion in the 3rd year. Remember, if the holder are exercising their choice, that means there was a choice which was there with the holders, and as a result, this is also an optionally convertible question. If the question remains silent, does not give you any hints like it is early redeemed or it is early converted, for example, in which case, if nothing is given, you can assume it is compulsorily convertible. But you have to look at the facts of the question and then come to a conclusion. Acha. Next, you have question number 6. This is on derivative accounting. So we have done around 2 to 3 questions on off market, 2 to 3 questions on compound financial, and now you go to derivatives. Derivatives, remember, are accounted for using FVTPL. Here on 1st January, Sam agreed to purchase $20,000 from JT Bank in the future on 31st December. So it's a forward contract expiring after 1 year. For a rate of 68, Sam did not pay any amount initially. So this is a feature of a derivative. Settlement at a future date, amount paid initially is nil or insignificant, and there is an underlying, in this case, the dollar. Sam is a listed company in India and prepares financials on a quarterly basis. Following classification principles as per 109, you are required to record entries for each quarter. Acha, for the purpose of accounting, please use the following information representing the fair values of the forward contract. Well, you will do FVTPL, fair value through profit and loss, at the first date, 1st of January, there will be no entry. Why? Because the fair value is nil. Why? Because you have not paid anything, you have not received anything, so there will be no entry. Then on 31st March, the question tells you that there is a negative fair value of 25,000. That means it's a derivative financial liability, and hence your entry will be fair value loss, which goes to the P&L, to derivative financial liability. This is 25,000. Acha, next on 30th June, your liability is 15,000. FVTPL, your liability should be 15. In your books, it is appearing at 25, and hence you will debit the liability on 30th June. Your entry will be derivative financial liability account debit. You will debit it by 10,000 to the profit and loss. Let us say you will credit it by another 10,000. As on 30th September 2011, the derivative financial asset, it is now a financial asset coming to 12,000, which means you will debit the financial liability. So derivative financial liability account debit. You will debit the financial liability by 15,000, which is there in your books. Debit the derivative financial asset by 12,000 to 27,000 will be shown as a gain. And then on 31st of December, the rate is 66. So if you assume the gross settlement, in which case bank account of USD will be debited to bank account of INR, I'll have to pay 20,000 into 68. That is 13,60,000 from my INR bank account and get $20,000 in my USD bank account, which in today's terms is worth 66 rupees. So $20,000 into 66 will come to 13,20,000. The balancing figure over here, it should be taken to the P&L. However, the derivative financial asset was there in your books at 12,000. You will reverse the derivative financial asset as well. So as you see over here, for the last entry, bank account of USD will be debited because that is coming into my account. To bank account of INR, you are paying from your INR account. You are reversing the derivative financial asset, and the fair value loss is going into your profit and loss account. Okay, so if there was a net settlement, for example, which was agreed, in which case directly you are not going to get any USD, you are not going to pay the entire 13,60,000, in which case the net 40,000 will directly be recorded as a loss. So there will be P&L account debit to bank, and derivative financial asset will also be reversed, so that will directly be adjusted. So in bank you will pay 40,000 net directly. Achha, next is the derecognition of financial liabilities question, where you have to check for subsequent renegotiation, where is it substantial modification or extinguishment accounting or not, has to be checked. Now, Wheel Company borrowed 500 million from a bank on 1st January. The original terms were as follows: 11% interest, repayment of principal in 5 equal installments, payment of interest annually, upfront processing fees 5.87 million. Acha, effective interest rate is 11.5. Now the question tells you effective interest is 11.5 and the question ends over here, which means is it at market or off market? We would say it is at market because apart from the loan, there is no other hidden element, and hence it should be recognized at fair value minus the transaction cost, which is 500 minus 5.87. Now this is the point where a lot of students have a problem, that why is the institute directly taking 494.13? Why is it not calculating the present value? Achha, if you want to calculate the present value, you can take 11.5% as the discount factor, discount the cash flows, you will come to exactly 494.13 only, because the transaction is at market. Because it is at market, institute has not shown the working differently, but if you want, you can show this. Now this 494.13 will be solved using amortized cost method, where 494.13 plus 11.5% interest minus coupon at the rate 11%, that is 500 into 11% comes to 55 in each year, less the principal amount. Principal amount paid in each year will be 100. So this is less 100 and you will get the closing balance. But on 31st December 2012, that is 2 years later, at the end of the second year, Wheel paid interest on the second installment but was not able to make the principal payment. Achha. They approached the bank citing liquidity issues in meeting the principal cash flows and renegotiated the terms as follows: interest rate is 15%, same as the market rate, and repayment of outstanding principal in 10 equal installments. So this is renegotiation. Now we have to figure out whether this is a substantial modification or not a substantial modification, for which we need to calculate the carrying value as on the date of modification as a first step. So if you find the carrying value starting at 494 plus effective interest at the rate of, I guess this is not 10%, this is 11.5%, less coupon, less principal. In the second year, you have defaulted, so principal is not paid, and hence this will be 397, which is your current carrying value. Compare it with the present value of modified cash flows. Modified cash flows at the old EIR. Old EIR is 11.5%, modified cash flows would be 400 is which is the outstanding principal, is now to be repaid in 10 installments. So that is 40 each, and the rate is 15%. So based on that, you will try to find the present value of the modified cash flows. All of these are not this. All of these are the modified cash flows, and based on an 11.5%, you will see 451. So if you want to find the difference over here will be 13.6%. You compare 451 and 397, find the percentage difference, that is 13.6%. Since the difference is greater than 10%, it is a substantial modification and extinguishment accounting applies. So you will derecognize the entire old loan of 397 and create a new loan. Now this new loan will be based on the present value of the future cash flows, discounted at the new EIR. Now this is new EIR, which is 15%, and as a result, this will give you if you find 400 rupees, and hence your entry will be loan. Your existing loan in your ledger is 397. You debit it to a new loan. You will credit at 400, and the balancing figure. The existing loan was 397.48. So the balancing figure is 2.52, which will be the loss on extinguishment, which will be taken to the profit and loss account. Okay, the financial guarantee question has been uploaded on YouTube itself. So if you search on YouTube financial guarantee, you will find the entire theory explanation along with the question. Okay, so in financial instruments, I would say 4 things are important. First, you will have loans at off-market rates. Second, compound financial instruments. Third, derivative accounting. And fourth will be derecognition of financial liability, extinguishment accounting. So these are the 4 most important things in the chapter on financial instruments. So that takes care of financial instruments, one of the biggest and one of the most important topics. Okay. So that is financial instruments. Next, you go to business combination. Now, there are 2 topics, business combination and consolidation, which kind of go hand in hand. We'll quickly discuss business combination. The initial part of business combination is largely theory. So when you're revising, keep less emphasis on that part. Give more emphasis to the numerical part of business combination, which involves calculation of PC, net assets, the big questions like the professional dynamic question, the reverse acquisition question, the demerger questions. These are questions where you will put greater emphasis on, in my opinion. So when we look at business combination comprises of business and control. Business refers to integrated set of activities where there are inputs plus substantive processes which have the capability of generating output. That is what is business. Control refers to ability to direct the relevant activities. Control is the power which gives you the ability to direct relevant activities where you have exposure to variable returns, and there's a linkage between power and the variable returns. Loosely speaking, greater than a 50% stake should ideally give you control. So over here, there is a lot of theory behind what is control, what is not control, less important. Business, less important. Okay. Accounting for business combination is what is important, where there are 6 steps in accounting for business combination. Determining the acquirer. Usually the person who acquires control is the acquirer. Usually in a normal acquisition, the person who pays the PC is also the person who acquires control, and hence he becomes the acquirer. However, in certain cases, especially where there is a reverse acquisition, the person who pays the PC does not necessarily acquire control. In fact, the other party acquires control. This type of transactions are called as reverse acquisition questions, where the legal acquirer is actually in fact the target from an accounting perspective. So that is the accounting acquiree, whereas the legal acquiree is actually the acquirer from an accounting perspective, whose accounting is given by reverse acquisition, which is a slightly important problem. Second is you are required to determine the acquisition date. Acquisition date is the date when control is acquired. If control is acquired at different, or if shares are acquired at different dates, the date on which controlling stake is acquired is the acquisition date. What is the relevance of this? Well, all fair values are to be calculated based on the values prevailing on the acquisition date. Next, we have purchase consideration or PC. PC is calculated based on the consideration that is paid to the owners as on the acquisition date. And when you are calculating PC, when you are calculating PC, a few things have to be careful. You have to be careful. First, PC includes cash paid plus the fair value of any securities, shares, debentures, bonds, or even assets like land issued. Apart from that, if there is deferred consideration, that is you are agreeing to pay certain cash after a few years, that is deferred consideration, then you will recognize that at present value basis. Or if there's a contingent consideration, then you will recognize it at fair value basis. Apart from that, if there are equity options like ESOPs and the employees of the other company have agreed to replacement scheme where the ESOPs of that they were existing holding will be replaced by new ESOPs of your company, in which case you will have to find the pre-combination element. So the fair value of the pre-combination element will be taken as a part of PC, and the remaining fair value will be taken as attributable to post-combination, which will be recognized in the P&L. So calculation of PC, step number 3 is important. PC, remember, also includes the fair value of the existing investments that you are holding. Next, you go to net assets. You have to take over 100% of the net assets, irrespective of whether you acquire 80% stake, 90% stake, or a 51% stake. You take over 100% of the assets, and because you take over 100% of the assets, for the remaining stake, you create what is called as a non-controlling interest or NCI. These assets that you have to take over will be irrespective of whether they are appearing in the selling company's balance sheet or not. So items like contingent liabilities, indemnification asset, in-process R&D, customer relationships, etc., even if they were not appearing in the selling company's balance sheet, as long as an identifiable fair value is attributable to them, they can be recognized separately at the stage of acquisition. Special cases in case of net assets can include contingent liabilities or indemnification assets, which are to be recognized at fair value, in process R&D, customer relationships, which are to be recognized at fair value as on the date of acquisition. Next, you have non-controlling interest. NCI is the percentage of shares of the subsidiary which are held other than that by the parent, and hence NCI is calculated as using fair value method, that you can find the market price of the shares into the number of shares held by NCI, or proportionate net assets, where you take the fair value of the net assets into the NCI percentage, will give you the NCI in rupees. Lastly, you will calculate goodwill. Goodwill is calculated as a purchase consideration plus NCI minus net assets, that will give you goodwill. There are two types of goodwill. One is a partial goodwill, one is a full goodwill. Within partial goodwill, your NCI is at proportionate net assets method, and hence the goodwill is only attributable to the premium paid by the parent, whereas in full goodwill, NCI is using fair value method, and hence the goodwill includes the effect of the premium paid by the parent as well as the premium included within the NCI's value as well. So this all these are the 6 important steps in the calculation of acquisition accounting, after which you can prepare a Schedule 3 balance sheet. Now, a couple of special cases involve directly attributable expenses. You need to remember that directly attributable expenses linked to the acquisition or even assets linked to the acquisition will go to the P&L. Further, there can be a deferred tax at the stage of business combination. If there's a deferred tax, when will you apply this? Well, if the fair value as well as the carrying value of the net assets are given and tax rate is available, in which case you will apply the same rules. If there's a difference where carrying value is greater than the tax base, then the answer is opposite and create a deferred tax liability. If there's a difference where the carrying value is less, carrying value means the fair value as per IND AS is less than the tax base, then you create a deferred tax asset to be applied only if tax rate is given in the question. Then there are certain special cases involving components of PC, where if in the purchase consideration there is some existing relationship or an employee who is getting settled as a part of the business combination, if you are paying PC, if the employee continues with a few years of service, then that is not a part of PC. In fact, it is treated as contingent consideration linked to employee service. There's also a concept of measurement period, where if new information is available within 12 months from the acquisition date and it pertains to conditions which were existing as on the acquisition date, then such new information is considered to be taken as a part of your business combination accounting, and the goodwill or NCI as calculated will be restated. If information is available within 12 months and it pertains to conditions existing as on the acquisition date, in which case the net assets can be remeasured. If the net assets are being remeasured, remember the NCI, if it is based on the net assets, will also be remeasured, and hence PC remaining the same, the balancing figure can potentially change, which will be impacting the goodwill. Then you have something called as a common control combination, which is if there is a transaction where pre and post the combination, the control continues to be with the same individual or the same group of individuals, it is called as a common control combination. Like acquisition of subsidiaries within the group is a common control combination. In case of a common control combination, you apply what is called as pooling of interest method. Under the pooling of interest method, you take over the assets and liabilities at book values, and the securities issued will also be at nominal values or book values, as a case maybe. Reserves or retained earnings will also be taken over, and if there's a difference between the consideration that you are paying and the net assets including the reserves as well, the difference is to be adjusted within the capital reserve. In case of demerger, there are 3 specific cases you need to remember. If there is a demerger and consideration is issued by the new company to the old company, in which case it is like a common control combination, because the new company will act as a wholly owned subsidiary of the old company, and hence control is with the same company. Second, if the shares are issued to the shareholders of the selling company rather than the selling company itself, then there is common control still, because ultimately if there's a controlling shareholder in the old company, that same controlling shareholder will also be the controlling shareholder in the new company, and hence the control remains common. However, in the last case where there's no controlling shareholder in the selling company and shares are issued to the shareholders of the selling company, there will be no controlling shareholder even in the new company, and hence in the third case you have a business combination. In the first 2 cases there is a common control combination. The accounting here, in case of demerger, in the books of the acquirer, in the first 2 cases you will take over assets and liabilities at book values, because it's a common control combination. Usually we do not take over reserves in line with the institute solution, because in demerger this will result in a selective transfer of reserves. In case of business combination, you take over assets and liabilities at fair values, and the difference, if any, will be taken to goodwill or capital reserve. In the first case, the difference will be taken to gain or loss on restructuring, again that goes into the capital reserve. In the books of the selling company, any particular IND AS does not apply. However, generally accepted accounting practices will apply, and based on GAAP or generally accepted accounting practices, if there's a common control combination and you are giving up, then you credit the assets, debit the liabilities at their book values. If you're getting the shares, debit the investment in shares, balancing figure will be taken to the capital reserve, gain or loss on restructuring. If you're not receiving the shares will not come in the first place. However, if it's a business combination, then this can result into a distribution of non-cash assets to owners, and if it's a distribution of non-cash assets to owners, then the balancing figure, if in the debit side, will go to the retained earnings. On reverse acquisition, if you have to do the accounting, the last part, if you have to do accounting in case of a reverse acquisition, in which case for reverse acquisition, you will first determine who is the acquirer, legal and more importantly accounting wise. Once you determine who is the acquirer, acquisition date, and then PC. Usually PC is a payment that is made to the owners of the selling company. Now the given PC in the question will be the payment going from the legal acquirer to the shareholders of the accounting acquiree or the legal acquiree. However, that is not PC because it is not payment made to the owners, and hence you will have to notionally determine that what would have been the PC had it gone from the accounting acquirer to the shareholders of the accounting acquiree. You will have to determine that. Again, you compare that PC with the net assets of the accounting acquiree, which are to be taken over at the fair value, to find the goodwill. Once goodwill is determined and you are asked to prepare the balance sheet, remember the balance sheet is prepared in the name of the legal acquirer. However, it represents continuing financial statements of the accounting acquiree, in which case you will take over assets, liabilities, everything of the accounting acquiree at fair value. The equity section will represent share capital of the accounting acquirer plus the PC. Institute does not show any breakup, and the reserves will continue to be the reserves of the accounting acquirer. So that by and large takes care of business combination. What we'll do is we'll try to address a few problems on this. So the first question is a question which is very popular, the professional and dynamic limited question, which has been asked 2 times in the exam. So don't do a trend analysis, it can very well come for the 3rd time as well. So over here, I really hope you would have gone through this question entirely. independently. So there is a balance sheet of Professional and Dynamic. So basically what is happening is Professional is acquiring a 70% stake in Dynamic, and for that Professional is paying 1 share of Professional for every 2 shares of Dynamic. This is a part of PC, and fair value of Professional is 40. So if you go to Dynamic, Dynamic has 400 rupees ke shares of 100 rupees each, that is 4 lakh shares. So this is 4 lakhs. We are acquiring 70% stake. So for this you are issuing 1 share for every 2 shares held, and hence every share is worth rupees 40. So this is a part of PC. So 4 into 70% into 1 by 2 into 40 comes to, let us say, 56. So as a part of your purchase consideration, 56 is to be taken. Fair value exercise results in the following. PP has a fair value of 350, so you will take over Dynamics PP at 350. Professional also agreed to pay an additional payment, which is higher of 35 lakhs or 25% of excess of profits. So we will study that entire case, but this is excess of profit after the year of acquisition. So we are considering that Dynamics profits will be exceeding by over its profits in the preceding 12 months. The additional profit will be due after 2 years. Dynamic has earned 10 lakhs profits in the preceding year and expects to earn another 20 lakhs. So over here one can say that, well, it is 25% of, let's say, 20 minus 10, and hence this is 2.5. So this is 2.5 or a fixed 35, whichever is higher, that is 35. Now this 35 had to be paid, and hence this is treated as deferred consideration. Acha, 35 के ऊपर अगर कुछ payment आता, then that is contingent, but 35 had to be paid, so we treat it as deferred consideration. This is to be paid after 2 years, and hence you recognize this as the present value basis. Discount rate is 10%, so this is 35 into 0.826. So this is 35 into 0.826, which is 28.91, will be taken as deferred consideration. There is nothing in the contingent consideration. In addition, Professional agreed to pay the founder shareholder payment of 20 lakhs provided it stays with the company for 2 years. Now this is payment linked to employee service, and hence this is not a part of PC. In fact, it will be recorded over 2 years as and when the service is rendered. Point D refers to replacement awards. So Dynamic had certain equity settled awards which got replaced by Professional as per original vesting period of 4 years, and the acquisition date employees have already served 2 years. So out of 4, 2 years have been served, and as per replaced awards, the remaining vesting period is reduced to 1 year. So it is, the total vesting period is 4 years. Now the revised vesting period is 3 years, out of which 2 is done, 1 is remaining. And the fair values of the original award are 5, replacement award is 8. So out of this 8, if I want to calculate the pre-combination element, the pre-combination element will be fair value of the original award, that is 5, into 2 upon the longer of the original vesting period, that is 4 years, or the revised vesting period, that is 3 years, and hence 2.5 is attributable to pre-combination element, which will be a part of PC. The remaining is attributable to post-combination element, 5.5, and hence it will be recorded over the year when the service is rendered. So this will not be affecting the acquisition accounting. Dynamic had a lawsuit pending with a customer who made a claim of 50. Management reliably estimates the fair value to be 5. As a part of net assets taken over, you will also take over a liability, a lawsuit liability, which is at fair value, which is worth rupees 5. Achha. The applicable tax rate for both entities is 30%. Now, if this sentence was not given, then the question was done. However, because of this question, you will have to calculate deferred tax. For deferred tax, you will calculate all the net assets of Dynamics as per books, which will include all of these items. So this will include 500, all of these, and all your liabilities as per books, all of these. That 5 rupee worth of liability will not be included as per books. Compare this with fair value. Fair value will include all of these same amounts. All of these same amounts except 350 for PP, and last month there is another 5 rupees worth of liability. So the difference between the two will be taken, and for that a deferred tax asset or liability will be calculated. So when we do the workings here, you will take the fair value of all assets and liabilities, carrying value of all assets and liabilities. To be honest, the only difference is in these items. So if you are clear, even if you take only these items, that is sufficient, you will get the answer. The difference over here is your fair value is 470, carrying value. The carrying value is the same as the tax base, and hence the IND AS value is lower than the tax base. So your answer is in the same direction. A net asset will give you a deferred tax asset. So there's a deferred tax asset worth 46.5. So when you do the workings over here, your fair value of assets are 470, plus a deferred tax asset of 46.5 and 516.5. If you want to calculate the goodwill, so when we look at this question, acquirer is professional, acquisition date is 1st of April, PC is 56 rupees plus 28.91 rupees plus 2.5 rupees, that is the PC. Net assets is 470 plus 46.5, that is 516.5, and NCI, if nothing is given, is a percentage of net assets, so that is 516.5 into 30%, and as a result your NCI will be equal to 154.95. Once you have these numbers, goodwill is PC plus NCI less net assets, and hence in this case there is a capital reserve. You can even show it as a gain on bargain purchase if the reasons are available, otherwise it will be the capital reserve. In the opening balance sheet, where will contingent consideration go? Contingent consideration is an obligation to deliver cash in this case, if there was an obligation, so it will be shown along with financial liabilities, non-current liabilities. If contingent consideration had come, here there is deferred consideration which will also go as a part of financial liabilities, non-current liabilities. Okay, next you will use all of this information. We have just given for reference a big entry where in the consolidated books of professional, all assets and all liabilities of dynamic along with the NCI, along with the purchase consideration, along with the capital reserve is to be incorporated, and hence you will prepare this entire schedule 3 balance sheet. Okay, so that takes care of question number 1. Next you have a demerger question. There is also a question which in our books, question number 59. It's also an interesting question, has a lot of adjustments, but it is very long, so probably may not directly come in your exams, but if it comes, you can even refer the question 59 of our books. Question 2 is on demerger. So we have picked up one question on regular business combination accounting, one question on demerger, one on reverse acquisition, etc. So enterprise has 2 divisions, the laptop division and the mobile division. The laptop division has been making constant profits, whereas the mobile division has been invariably suffering losses. So on 31st March 2012, division wise draft statement of the balance sheet was as under. So this is the division wise statement. Division mobiles along with the assets and liabilities, this is the division mobile, was sold for 25 crores to Turnaround Limited, a new company who allotted 1 crore equity shares of rupees 10 each at a premium of 15 per share to the members of enterprise, Okay, so PC is going to the members of the selling company. In full settlement of consideration in proportion to their shareholding, one of the members of enterprise holds a 52% stake of the company, which means there is an investor who holds 52% stake of enterprise. That same investor will also be considered to hold control in turnaround, and hence this transaction will be classified as a common control combination because PC is issued to members and there is a controlling member, and hence this will be a common control combination. Assuming there are no other transactions, you are asked to pass the journal entries in the books of enterprise. Enterprise is the selling company, which means debit what comes in, credit what goes out. So over here what is going out is assets, so you will credit the asset by 500. Provision for depreciation as a credit balance, you will debit it by 400. Current assets will be credited by 500. Current liabilities will be debited by 400, and loan funds will be debited by 300. In return, are you getting any consideration? No, consideration is flowing to the members, and hence there is nothing else. So the balancing figure, if any, will be the gain or loss on restructuring. So you will remove the fixed assets, remove the current assets, remove the provision for depreciation, current liabilities and loan funds, and the balancing figure over here will be the capital reserve, which is the gain or loss on restructuring. You will not remove the reserves because IND AS does not permit selective transfer of reserves. Second, you will pass the entry in the books of a balance sheet in the books of enterprise. So enterprise, the balance sheet will be basically, obviously you will prepare in schedule 3 format, but it will be after removing the mobile division. So basically it will be very similar to the balance sheet under the laptop division, just that. So it will be almost the same. Fixed assets, depreciation, current assets, current liabilities will appear on the liabilities side. Loan funds will become 0. There will be capital of 25. Surplus over here, this will remain the same till here. Surplus over here will be for the company as a whole, which is 75, on which you will add 100 rupees, and hence it will become 175. So if you go to see, everything is the same. This is other equity, which is 175, which is made up of your capital reserve, which is again on restructuring 100, as well as the surplus of 75 rupees. And the last part is you are required to prepare balance sheet of turnaround. So in turnaround, basically you will have almost the entire balance sheet of the mobile division. So your PP will appear at 100 that you take over. Current assets will appear at 500. That's it on the asset side. On the equity side, you are issuing shares. You are issuing 1 crore shares of rupees 10 each. So that will be 10 crores. In the equity share capital, these shares are issued at a premium. So this is 1 crore into 15. That is 15 going into the securities premium. And then liabilities comprising of loan funds of 300, current liabilities of 400. When you pass the takeover entry, you will take over assets, you will take over liabilities, and you will issue shares. If there is a difference, the difference will be again adjusted into capital reserve because it is a restructuring. There will be no goodwill. It's a common control combination. So over here in the books of turnaround, for reference, in order to find the balancing figure, you can pass the general entry PP account debit, current assets account debit, to loan funds, to current liabilities, to equity share capital, to premium, and then there is capital reserve. Can capital reserve have a debit balance? Well, why not? P&L has a debit balance, and so can capital reserve. It can very well have a debit balance as well. And hence, based on that, you can prepare the balance sheet of turnaround. Next, we have question number 3, which is one of the only big questions, I would say, which has never come in the past. So, if you look at your study material, whether it is our book or any author's book or institute material, there are 3 or 4 really big questions. First is a question on at AX, BX, first is a question of professional dynamic, has come multiple times. Then you have demerger question like turnaround and enterprise, or maxi, mini and mini has come multiple times. You have the question at the end of AX, BX, which has also come multiple times. However, this is the only question which has not yet come, and hence I would kind of put some weight behind this for your preparation. So if you understand this, excellent. Otherwise, it's a difficult question to understand. We have put a separate video exclusively on the concept of this question and the solving. So if you have time and if you want a better understanding, do refer that. Here we just broadly discuss, because this has not yet come in the exam. Okay, so over here this is a question where there is an entity A which is issuing shares to entity B. B has 60 shares, and against those 60 shares, A is issuing to the shareholders of B 60 into 2.5, that is equal to 150 shares of A. Now, if you look at the post combination entity, the way the question is given, the post combination entity, the shareholders of B get 60% share in A, and the shareholders of A only have a 40% share in A, and as a result, the control of A's shareholders over the business of A is actually lost. So A's shareholders no longer have control over the business of A. However, when we look at B shareholders continue to have control over the business of B. In fact, they also have control over the business of A, and hence the question itself tells you that the legal acquirer is A, but the accounting acquirer is actually B. So this is a reverse acquisition question where the accounting acquirer, that is B, is actually the legal acquiree, that is a target, whereas the the legal acquirer, that is A, is more of an accounting acquiree. Okay, so over here on 30th September, A issues 2.5 shares for each ordinary shares of B. All shareholders exchange their shares in B. So again 60 into 2.5, that is 150 shares. A issues 150 shares in exchange for 60 shares of B. The fair value of B shares is 40 and quoted market price of A share is 16. The fair value of assets, if you see, is given for A is 1500, everything else is at the same value. Balance sheets are given. This is for legal parent and the accounting acquiree. B, this is the legal subsidiary and the accounting acquirer. So you have all the data given, and assume there are certain data given regarding B's earnings. What do we have to do? You have to find the fair value of the consideration transferred, so that is PC, goodwill, and prepare the balance sheet of these companies. EPS Institute has removed from its question due to the inherent complexity. They have kind of reduced. Yes, you can pass journal entries even if it is not asked in the question. There is no problem in that. If it is asked, it is a part of the main solution. Otherwise, you can show it as a part of the workings. Okay, so we first figure out that shareholders of A get a 40% stake, shareholders of B have a 60% stake, and as a result, this is the position post the acquisition. Now, if this was a normal acquisition, if you want to find PC, 150 shares are issued to shareholders of B. Shareholders of B are not the shareholders of the selling company, and hence those 150 shares cannot be PC. Then what is PC? Well, PC refers to the payment that if there was a normal acquisition and company B would have paid to the shareholders of A. What would have company B paid to the shareholders of A? Now, A has, for example, 100 shares. If that was to be exchanged with shares of B, 100 divided by 2.5, we would have issued 40 shares of B. And hence 40 shares of B would be paid by B to the shareholders of A in exchange of their 100 shares, and hence this 40 shares would be a part of PC. Or 40 shares of B at the fair value of rupees 40, that is 1600. Or we can say against those 40 shares, we are getting 100 shares of A which have a quoted market price of 16, and hence the payment to the shareholders of the selling company, that is payment to A's shareholders, will be a part of PC. So 1600 will be a part of PC. Now 1600 can be calculated as 40 shares issued to those shareholders, 40 shares of B into the fair value of B, or you can also calculate it as 100 shares of A into 16, which is a quoted market price. As per IND AS 113, we take the level 1 category input, that is quoted market price, and hence 1600 is taken. You compare this PC with the net assets. Net assets will be the fair value of assets and liabilities of A. You will take over assets and liabilities of A. Assets and liabilities of A will be taken over at fair value. So, you will compare that with the PC to find the goodwill. Now, once goodwill is calculated, so as you can see, PC is 1600, then you can calculate net assets is 1300 and goodwill is 300. You have to prepare the balance sheet. While you are preparing the balance sheet, you will take over all assets, all liabilities. Reserves will be the reserves of B, name will be that of A, and hence institute over here shows the equity as 600, that is the share capital of B plus PC, that is 1600. Now, strictly speaking, that has to be in the name of the acquirer, so A Limited, and hence you need to show the number of shares in the acquirer. Balance, if any, can be shown into a separate temporary account, but institute has not gone into the detailed disclosure. They have just shown 600 plus 1600, so even if you show that, that is sufficient. Okay. Next, you have question number 5, which is also an important question on AX BX. So all of these questions have come in the exam except for this reverse acquisition question that we just did. So let us refer this AX BX question. AX Limited and BX Limited amalgamated on and from 1st of January. The new company ABX was formed to take over the business of the existing companies, and the summarized balance sheets are given. So you have been given fairly detailed balance sheets. ABX issued the requisite number of shares to discharge the claims of the equity shareholders. Equity shareholders for of the transferor companies prepare a note showing the purchase consideration and the discharge thereof and draft the balance sheet, assuming both companies are under common control. So if they are common control, are you given about the PC? Well, if you read further, it is given assume BX is a larger entity and their management will take control of the entity. The fair value of net assets of AX and BX are as follows. So you have the fair value of fixed assets, inventories, and the fair value of the entire business. Remember, fair values are to be looked at only if there is an actual business combination. If there's a common control combination, then the transactions will be recorded at book values. So when you are looking at book values, you will take all the assets and all the liabilities. So over here, you will take over all the assets and all the liabilities at book values. So basically, you will take for AX and BX all the book values. So basically, for total assets 13,050 and 15,200 minus all the liabilities. So this is 3,000 and 1,000. This is 4,000 and 100. Also other equity. Because in case of a common control combination, assets and liabilities including reserves are taken over. So basically, for AX, you will take over assets of 13,050 minus liabilities of 4,000, which means this comes to 9050. But this is net assets before taking over reserves. You will also take over reserves. Reserves have a credit balance. This has a debit balance. Reserves has a credit balance of 3050. This is a credit balance, and hence for AX you will have 9050 minus 3050 comes to 6000. This is basically equal to the share capital. Same is the case with BX. if you look at BX, this is 15,200 minus 5,500. So this is 15,200 minus 5,500 comes to 9,700 on the net debit. You are also going to take over the reserves for 2,700, which is net credit, and hence this will come to 7,000, which is also the share capital. So basically the total consideration that I'm going to issue is going to be 13,000. But this 13,000, in order to ensure a fair discharge, should be given in the ratio of net assets before deducting reserves. If you take the net assets after deducting reserves, then as we had discussed earlier as well, you will not do a fair distribution, because there may be a company which has 1,000 of assets financed by 100 of capital and 900 of loan, and another company 1,000 of assets financed by 100 of capital and 900 of P&L. Second company is a better company, should get a larger share in PC. But if I look at net assets after deducting reserves, both of them will be given an equal share, which is wrong, and hence this 13,000 will be attributed between the two parties in the ratio of their net assets before deducting reserves. So 13,000 will be distributed in the ratio of net assets before deducting reserves, and hence if you go to see 6275 and 6725, so this is 6725, 6275 and 6725 will be the PC. Now over here you are taking over assets and liabilities cumulatively worth 13,000, and you are also issuing shares worth 13,000, and hence there is no balancing figure. So if you take the totals over here, you will just total up every line item. So in the first case, it is just a pooling of interest. So this is 8,500 and 7,500. So this is probably what, 16,000. Next you will have investments. This is 1,600. Inventories will be 4,000. Trade receivables will be 5,800, cash will be 850. Even share capital is 13,000. I mean, it is 6275 and 6725, but total comes to 13,000. Even reserves are taken over under pooling of interest. So this is 5750. Borrowing is 7,000 and trade payable is 2,500. So if I total up all of these, I'm still going to get the same answer. If you have skipped business reverse acquisition, if possible, just try to refer that one video that I have put on YouTube on reverse acquisition. To the extent आपको समझ में आता है, थोड़ा उतना समझो, and then you forget it. भगवान का नाम लेके एग्जाम में जाने का, okay? So if it comes and if you are pushed against the wall to attempt, you can at least do some patchwork and get some stepwise markings. Okay, this is the first part. Second part, assuming BX is a larger entity and their management will take control over the entity, which means there are two transactions. ABX is acquiring AX, ABX is acquiring BX. So it legally appears that ABX is acquiring BX. However, BX is the larger entity and BX ka management is acquiring control over the business of ABX, and as a result, that is a reverse acquisition where it appears that ABX is acquiring BX. However, it is BX who is actually accounting wise acquiring ABX, and hence over here, all the assets and liabilities of ABX will be taken over in the books of BX at fair value. BX ke assets and liabilities will remain in the exact same way. So the transaction between ABX and BX will be all assets and liabilities, if any of ABX, will be folded up into BX at their respective fair values, but BX ke assets and liabilities will remain at the same book values. However, when you look at AX, the transaction between ABX and AX is that of a business combination, and hence you will take over assets and liabilities of AX at fair value. So when you are taking that over, you will take over the fair value 9,500, 1,300. How much PC are you going to pay? AX will say, well, it's a business combination, which means you have to pay me 11,000 rupees. That is the value of my business. Okay, then ABX/BX will say, okay, so if your net assets are coming at fair value, the shares that I'm issuing are also going to be at fair value. ABX holds the business of BX, which has a value of 14,000, and that is currently held by 700 shares. So over here, if you go to see, it is currently held by 700 shares. So 14,000 worth of business value is held by 700 shares, and hence the value of each share is going to be 20 rupees. And as a result, we will say that, okay, AX ka business will be taken over, and in return we will issue shares which are worth 700, which are worth 20 rupees, and hence 550 shares will be issued to the shareholders of AX. Based on that, you will construct the entire balance sheet. Okay, so this question honestly requires, all of these questions require a fair bit of time. In class, almost every question takes more than an hour, more than 1.5 hours. So just to kind of run you through at this point, we've just discussed the basic pointers without kind of going into the nitty-gritty of each and every calculation base. Okay, so that takes care of business combination. Next, you proceed on to consolidation of subsidiary. So consolidation is something that you do after business combination is done. In consolidation, there are two particular categories of questions which are institute favorite. One is a Ram Krishnan type of a question where there's a single subsidiary and there are fair value adjustments, dividend adjustments, etc. Second is the chain holding question. So these two questions keep on repeating year after year, and hence you focus on that. Apart from that, a question which had come in the January 21 paper, which is also a slightly important questions. Other questions relating to subsidiary consolidation not as important. In joint ventures and associates, we typically try to focus on the equity method of accounting. That is slightly important. Okay, so over here, when you look at consolidation of subsidiary, we will first focus on the subsidiary consolidation, which is full line by line consolidation. You start consolidation from the date of acquisition and continue till the date control exists. The method that you follow in this chapter is slightly different from the method that is followed in business combination, though both of them are fully applicable. So which method to follow? Well, usually if you have to prepare the balance sheet as on the date of acquisition, then you can follow the method that was used in business combination. However, if you have to prepare a balance sheet 1 or 2 years later from the date of acquisition, then the method that is discussed over here can be followed. Now, earlier, if you have taken an earlier batch, we were usually preparing an account called as a cost of control, and we were preparing workings using that. Now we are preparing it on same basis, just that instead of preparing a ledger, we are preparing kind of a statement or a table. In the exam, you can safely follow any of the methods. We have seen a lot of suggested or evaluated copies, certified copies, where marks have been awarded irrespective of the method followed, because ultimate answers remain the same. It is just that one place you are preparing a ledger, other place you are preparing a statement. At the end of the day, it is a working note, so either of these can work. So over here, the core principles of consolidation include: you will take over all assets and all liabilities at full values, 100% values irrespective of the stake. For the percentage that is not held by you, you will create a minority's interest, or also called as a non-controlling interest, which can be measured using proportionate net assets method or using the fair value method. In the SFS of the parent, there will be an investment in the subsidiary. You will eliminate that investment in the subsidiary against the share capital and the pre-acquisition reserves attributable to the parent. Difference, if any. So here you compare the PC, that is the investment that you have made, with your share of the net worth or net assets as on the date of acquisition, and the difference, if any, will go to the goodwill in case of a partial goodwill method. Acha, post acquisition, if any profits are earned, a part of those profits are attributable to the parent, a part of those profits are attributable to the NCI. To the extent they are attributable to the parent, you will consolidate them with the respective reserves. To the extent it is attributable to NCI, you will add it to the NCI. So steps that are to be followed in the consolidation process is: step number 1, you prepare the Schedule 3 format of the balance sheet. Once you prepare the Schedule 3 format, you prepare the notes. Within notes, you will write down all assets and all liabilities which are appearing in the parent and the subsidiary's books, except for investment in the subsidiary, except for share capital of parent, share capital of subsidiary, reserves of parent, reserves of subsidiary. You remove this and everything else will be written in the notes. Notes can be prepared in a tabular format, or if you have time, then asset by asset, liability by liability, a different note can be prepared. Then you take the share capital of the parent in the notes, and then you have 3 crucial working notes. Working note number 1 will be consolidated other equity. Working note number 2, calculation of goodwill or the cost of control, and working note number 3 on non-controlling interest. When you prepare these working notes, leave around 8 to 10 lines for each of these notes. In the working note on consolidated other equity, you will start with the standalone profits or standalone balances of the parent. Then when you prepare the cost of control or the goodwill workings, you will start with the investment amount, and then from the investment amount, you will reduce or credit, as a case may be, your share in the equity share capital of the subsidiary. So if equity share capital of subsidiary is 1000 and parent has 80% stake, then 800 will be taken over here. The remaining 20%, that is 200, is attributable to NCI and hence will be created or added along with the NCI. So at this stage, you have covered everything in the question except for the adjustments and the reserves of the subsidiary. So the next step, you can prepare the analysis of the reserves. While you are preparing the analysis of the reserves, you can either do it on a chart format or on a table format. You start with the opening balance, add to that the profits, less dividend if any will give you the closing balance. Once you do that working, you analyze whether opening is pre, whether dividends are paid out of pre-profits, profit during the year are pre or post. If they are pro rata, then you allocate, find the workings. Leave around 8 to 10 lines and then do the adjustments. Adjustments over here can include the fair value adjustments, can include the upstream or downstream adjustments, can include dividend adjustments, the 3 most important adjustments, and then there can be a various variety of other adjustments like intercompany items, like uniform accounting policies, different reporting dates, different currencies, etc. You will do these adjustments and then you will try to find the adjusted profits, attribute a part of it to the parent, a part of it to the NCI. Parent's share in pre-acquisition profits goes to the goodwill workings. Parent's share in the post-acquisition profits goes to the consolidated profit and loss or consolidated other equity. NCI share, whether it's pre or post, will go to directly the NCI working. Now, after that is done, you will see if there is any other adjustment remaining, intercompany items, eliminations, and after that you will total up all the notes, take the numbers in the balance sheet, and then pray to God that your balance sheet tallies. Okay. Now, there are a few common consolidation adjustments which we will try to discuss. One is negative non-controlling interest. Under IND AS, non-controlling interest can be negative, so there's no problem. If it comes to be negative, it will be a debit balance. You don't show it on the asset side, you will show it as a negative balance within the equity section only. Fair value adjustments, if fair value adjustments can be due to differences in fair value at the time of acquisition, these differences can be for PP, can be for inventories, can be for payables. Whenever there is a difference at the date of acquisition, then the difference between the subsidiaries ledger balance as on the date of acquisition and the fair value will be adjusted against the pre-acquisition profits, because this is attributable to changes which have already happened at or prior to the acquisition date, so it will be adjusted against the pre-acquisition profits. If there are any changes which are happening post the acquisition, like depreciation on PP or sale of inventory or payment of a payable, these will be adjusted from post-acquisition profits. So the thumb rule is, if there are any fair value differences at the acquisition date, they will be adjusted from pre-acquisition profits. If there are any changes post the acquisition, they will be adjusted out of the post-acquisition profits. Okay. Next, there's a common adjustment involving goodwill impairment. So goodwill impairment, if it is partial goodwill, then the gain or then the impairment will be adjusted only against the parent share, that is consolidated P&L. If it is full goodwill, then the impairment will be adjusted both against the parent as well as the NCI. If there is unrealized profit on intercompany transactions like intercompany debtors or creditors, if there is unrealized profit, if it is downstream, that is parent has sold to the subsidiary, then the profit is in the books of the parent. You will debit the parent's P&L, credit the inventory. If it is upstream, then the profit is in the books of the subsidiary. You will debit the subsidiary's P&L and credit the inventory. But subsidiary's P&L has to be analyzed. So we have to figure out how much of this is pre, how much of this is post, based on the date of sale. If nothing is given, we will assume that the sale happens in the post-acquisition period, and hence this is entirely post. Okay. The same principles apply if there are unrealized losses, or even if there is upstream or downstream sale of PP. Just that if it is an upstream or downstream sale of PP, then additionally there will also be an entry involving which is involving depreciation. Next, you have uniform accounting policies. Remember, it is necessary that the parent and subsidiary has to have uniform accounting policies to the extent practicable. If not, you will have to restate the subsidiary's financials to bring it in line with the parent's accounting policies. Restatement is needed for different accounting policies. It is not needed for different accounting estimates. If there are different reporting periods, then if the difference is greater than or equal to 3 months, then you will have to again prepare the full balance sheet and solve. However, if the difference is less than or equal to 3 months, then you can just make adjustments for material events and prepare a restated balance sheet and then do consolidation based on the restated balance sheet. Intercompany eliminations involve debtors or creditors, intercompany loans given, loans taken, bills receivable, bills payable, debentures or preferences. Usually these numbers cancel each other accurately. However, in case of debentures or preferences, it is possible that parent had invested in 100 debentures of the subsidiary at the rate 150, and in the subsidiary's books these debentures are appearing at 100 only, in which case 50 over here will be the loss. which will be taken to the P&L, because this is not on owners. This is on account of settlement of a liability, and hence it will be adjusted against the consolidated P&L account. Dividend adjustment over here, if dividend is paid out of the post-acquisition profits, there is no separate adjustment that you need to do. However, if dividend is paid out of pre-acquisition profits, that is advisable if you do an adjusting entry to the extent of parent share of the dividend. So the entry over here will be, you will debit consolidated P&L, because in the parent's P&L you would have shown this as income, so you will debit the P&L of the parent because it is intercompany dividend income which must have been shown, and credit your share of the net worth, because this must be there on your net worth as on the date of acquisition. So to the extent of parent's share of pre-acquisition dividend, you will pass the entry P&L of the parent or consolidated P&L account debit to your share of the net worth, or credit the cost of control as the case may be, and everything will fall in place. We have done a similar adjustment also for bonus, though bonus is not as important from an exam perspective. Dividend is. Bonus, you need to be careful in calculating the stake which must be existing as on the date of acquisition, considering either pre-bonus number of shares in the numerator and denominator, or considering post-bonus shares in the numerator and denominator. If nothing is going, we'll always assume that the bonus is paid out of the pre-acquisition reserves, not out of the post-acquisition reserves. In any case, it is always advisable to reverse the effect of bonus and then do the working, in which case things should ideally fall in place. If there's an additional stake purchase, if that additional stake purchase gives us control, IND AS 103 applies. You will have to remeasure the existing stake, take over the assets, take over the liabilities, create goodwill. However, if there's an additional stake purchase after control is acquired, like 70% you have and you take another 10%, this is treated as purchase of NCI. Again, it is an owner-to-owner transaction, and hence your entry will be NCI account debit to bank, and the balancing figure will directly go to other equity. This is in case of additional stake purchase. If there's a stake sale, again similar principles, you will see if that stake sale results in acquisition of control, loss of control or no loss of control. If there is no loss of control, it is a transaction treated as creation of NCI, where your entry will be bank account debit to NCI, and the balancing figure over here will again be taken as other equity. That is gain or loss on creation of NCI. While creating NCI, you will take the net assets including the goodwill at this stage. In case there is loss of control, in which case this is treated as a sale of net assets transaction, in which case you will credit the net assets of the subsidiary, debit the NCI as applicable, credit the liabilities, debit the liabilities and debit the bank account. So this is like a sale of assets, bank account debit, NCI account debit, to net assets, to goodwill. If there's a balancing figure at this stage, this will go to the profit and loss account because it is treated as a sale of assets transaction. Apart from that, it is possible that you retain some of the investment, like you retain a 15-20% stake in the company. This investment which is retained will be recognized either at fair value or proportionate carrying value at the date of retention. So this will be taking care of your stake sale. Then there is chain holding, which is important. In case of chain holding, there are 3 or 4 things that you need to remember. First is assessment of control. You figure out whether on the subsidiary the parent has control. P has a 80% stake in S1, S1 has a 60% stake in S2. Does P have control over S2? Well, mathematically it is 80 into 60% and hence it is 48%. However, effectively P can direct S1 to do what it wants to do with this entire 60% shareholding in S2, and hence P has control, and hence S2's assets and liabilities will be consolidated with P, irrespective of the fact that P's effective stake is only 48%. So how will NCI be calculated? NCI will be calculated as 100 minus P's effective stake in S2. So 100 minus 48%, that is 52%, will be treated as a non-controlling interest. Next, if you have to determine the acquisition date is the date when control is effectively acquired by the ultimate parent, and the changes in the consolidation process involved. You will still prepare the Schedule 3 balance sheet. Once you are done with the Schedule 3 balance sheet, then you will try to calculate the NCI. NCI for S1 is very easy, but when you do NCI for S2, it is 100 minus P's effective stake. That will give you NCI for S2. Once that is done, when you do the goodwill workings, remember investment in S2 appears in the books of S1. If you remove any asset in the books of S1, it belongs to parent and NCI both, and hence the investment in S1's books will be adjusted between the goodwill working as well as NCI, because a part of the investment is attributable to the NCI as well. So that is something, this entry is something that you have to be slightly careful with. Achha, exemption in preparing CFS is available to intermediate companies provided if it's a wholly owned subsidiary or if it is a partly owned subsidiary, in which case it is not listed and intimation is given to the other shareholders and none of them raise an objection. Apart from that, exemption is available also for investment companies. Investment companies are with the objective of investment management services, primary objective to earn returns and capital appreciation solely, no other business connection, and lastly they assess the performance on a fair value basis and not on an overall business performance basis. Okay, so this is about consolidation of subsidiary. When you look at joint ventures, joint operations and associates, which is also a larger, which is a part of this larger chapter, then in case of joint operations, there is possibility of a joint control. Joint control is collective control, or it can involve unanimous decision making. Remember, for something to be shown as a joint arrangement, it is important that you show the existence of a joint control. If there is a joint control, we can consider that there can be a joint arrangement. Joint control can be explicit, implicit, oral, written, formal, informal, it does not really matter. Once there is joint arrangement, we need to figure out whether it is a joint operation or it is a joint venture. If it is a joint, if there is no separate entity in the middle, it is always a joint operation, in which case accounting happens using the proportionate consolidation method. However, if there is a separate entity in the middle, we need to see whether the ultimate interest in the assets and liabilities is flowing to the venturers or is the ultimate interest in the company itself. So if all the benefits are going to the partners, or if the venturers have direct interest in the asset and liability, they are getting exclusively all of the revenue, in which case it is still a joint operation, in other case it is a joint venture. If it is a joint venture, then your accounting will be using the equity method. Similar is the accounting for equity method even under associates. Associates refers to existence of significant influence, that is usually at 20% or above stake, where you have the ability to participate in policy making, however you do not have control, in which case it is significant influence. Even significant influence is accounted for using the equity method. What happens in case of a proportionate consolidation? Proportionately, all assets and all liabilities are consolidated. Under equity method, no assets or no liabilities are consolidated. In fact, you will show investment. But this investment is shown using a separate method called as the equity method, which we will study, which in my opinion is the only thing which is the most important in this chapter. So when we are looking at equity method, what are the features of equity method? Well, assets and liabilities are not taken over in case of equity method. Further, because it is equity method, how is the investment valued? It is not valued based on the fair value. In fact, it is valued based on how the equity of the entity is changing. That is, how is the net assets of the entity changing? Why should the net worth change? Well, if the share capital changes, if the retained earnings changes, if OCI changes. So investment account debit to your share in the net worth, that is your share in the retained earnings, your share in let us say the OCI items. So because you are participating in policy making, you don't wait for the income to be distributed. You can recognize income the moment it is kind of earned by the associate. However, when dividend is distributed, this dividend is not again taken to the P&L account, because the income would have already been taken to the P&L account. Dividend, whether it is out of pre or post acquisition profits, will be reduced from the investment. Dividend is treated as recovery of investment, entries bank account debit to investment. You will not do any intercompany elimination of assets and liabilities, because you are not taking over assets and liabilities of the associates. So debtors and creditors will continue to appear as it is. However, intercompany unrealized profit to the extent of share of the parent will be eliminated, because you are taking over the profits and losses to the extent of your share, and hence you will eliminate. What happens in case of goodwill? Well, because investment is shown as a separate line item, assets and liabilities are not taken over, goodwill does not appear as a separate line item in the balance sheet. However, goodwill has to be separately identified and disclosed. So you will separately identify and disclose the goodwill as the case may be. Okay. Then you have losses. So in case there are losses, then the working is exactly the same. You will reduce your share of losses from the investment till the time the value of investment becomes zero. Beyond zero, you will not take unless there are certain long-term interests other than equity, like preference shares or long-term loans where settlement is not planned. Only in that cases, for which I've put a separate video of around 30-40 minutes. It's a fairly complicated concept, not very important from an exam perspective, has never come, but if it comes, you can refer that long-term interest in associate section. Exception to the application of equity method. Again, if you are an investment entity, then you can show the assets, like in case of subsidiary investments as well. If you are an investment entity, you can show it at fair value through profit and loss account, or you can follow the equity method as well. This can be for direct as well as indirect investments. Okay, there's a separate standard IND AS 27 which is for accounting for these investments under SFS. Under SFS, investments in equity shares of subsidiaries, associates or joint ventures can either be shown at cost or using IND AS 109 principles. Unless given otherwise, we always assume that they are shown at cost. Okay, now based on this, we will kind of study a few questions and then proceed. So let us go to question number 1 on the consolidation section. Okay, Ram acquired 60%. So these are the 2 or 3 questions. If you have not done anything in consolidation, at least do question 1 over here and question number 3 of chain holding. Majority chances are one of these 2 questions or questions on similar lines do come. Ram acquired 60% of the ordinary shares of ₹100 of Krishnan on 1st October. So this is date of acquisition. 60%. So Ram is the parent, Krishnan is the subsidiary. On 31st March 2012, the summarized balance sheets of the 2 companies were given below. So this is for Ram and Krishnan, the summarized balance sheets. So PP, land and building, plant and machinery, investment in Krishnan. Okay, so we have an investment in Krishnan to the extent of 8 lakhs, inventory, trade receivables, cash, equity capital, other reserves, retained earnings, bank overdraft and trade payables. The retained earnings of Krishnan showed a credit balance of 60,000 on 1st April. Remember, the date of acquisition is not 1st April, it is actually 1st October, out of which a dividend of 10% was paid. So this is paid out of the balance on 1st April. So this is entirely pre-balance and hence the dividend is paid out of pre-acquisition profits. On 1st November, Ram has credited the dividend to the retained earnings. Okay, so this has already been done. The fair value of plant and machinery on 1st October was 4 lakhs. The rate of depreciation on plant is 10%. The following are the changes in fair value. So you have been given the changes in the fair value as per the respective IND AS on 1st October, which are to be considered in the balance sheet. So you have been given changes, you are required to prepare the consolidated balance sheet. So the first step over here will always be to prepare Schedule 3 balance sheet, where you will prepare this entire format. In the second step, you will prepare notes to accounts, where you will write down all of these items, all assets, all liabilities, except for investments, except for equity shares, except for other reserves and retained earnings. Once all of these are written, you will prepare 3 working notes. All of this is taken. One is working note number 1, which is on consolidated other equity. So let's say this is working note number 1 on consolidated other equity, where there is other reserves and then there is retained earnings, where you will start with standalone Ram. So standalone Ram over here will be 6 lakhs and 1,14,400. 6 lakh, 1,14,400. Then you will have working note 2, which is a goodwill calculation, where you will start with the cost of the investment. So the cost of the investment I think is 8 lakhs. So this is also taken, and then you subtract the share, your share in the net worth or net assets as the case may be. And then working note 3 will be non-controlling interest, which in this case is 40% to be calculated using proportionate net assets. Equity share capital, 60% of the share capital will be taken over here. So this is 60% of, I guess, 4 lakhs. 60% of 4 lakhs comes to, I guess, 2,40,000, and the remaining equity share capital, which is 40%, which will come to 1,60,000. So this equity share capital, let us say, comes to 1,60,000. Okay. Once this is done, the only thing that remains is the reserves. So unless given otherwise, we will assume that the reserves, the other reserves must be existing as on the date of acquisition. So this 2 lakhs will be entirely pre. If it is pre, out of this 60% is attributable to RAM, 40% is attributable to NCI. So out of this 2 lakh rupees, if nothing else is available, we will say pre other reserves, I think 1,20,000, and pre other reserves will be 80,000. So this takes care of 2 lakhs. So the only thing which remains is 1,64,000, the retained earnings. Now usually the workings for this will be, you will start with the balance on 1st April 2011. This will increase due to profits during the year, and this will fall due to the dividends paid. That will usually give you the closing. The closing is 1,64,000. The question tells you that the opening over here is 60,000. Now this opening is entirely pre, and out of this opening, the question says 10% dividend is paid. So 10% is a percentage of share capital. Share capital of the subsidiary is 4 lakhs. 4 lakhs into 10% will come to 40,000. So this is 40,000 which is paid out of the balance over here, and hence 60,000 will go in the pre column. Even 40,000 will go in this pre column, which means whatever is left over is a balancing figure. So this is, I think, 1,44,000. Now 1,44,000 is the profit for the entire year 11-12, but the date of acquisition is 1st of October, and hence half of this, that is 72,000, is in the pre period, half of this is in the post period. So this is how you analyze the profits. So this is 72,000 in the post, and I guess 92,000 in the pre. So this is what, 60, 72 minus 40, that's right, 92,000. After this, you will look at the adjustments. Now in the adjustments, there are 2 adjustments. One is for dividend, which is paid out of the pre-acquisition profit. So this will be P&L of RAM, which is debited to the share of net worth, which will be credited because this dividend was there, the net worth was there as on the date of acquisition. So this is total dividend of 40,000. Out of 40,000, RAM received 60%, and hence this is to the extent of 24,000. This 24,000 is credited to the retained earnings, and hence it has to be debited. So over here, this will be, let us say, less pre-acquisition dividend. So the pre-acquisition dividend over here is 24,000, which must have already been included in the 1,14,400. You will subtract it, and the second effect over here will be the pre-acquisition dividend, which will come at 24,000 over here. So this is one adjustment done. The second adjustment is a fair value adjustment. At initial recognition, if you want to find the fair value adjustment, you will say that the land account will be debited. Land will be debited by how much? 2 lakhs. Inventory by 30,000. Land is debited by 2 lakhs. Inventory debit by 30,000. Plant will be debited, for which you will have to do a separate working. 2 trade payables will be credited by, let us say, 20,000. Now, how will you find the changes in the value of the plant? You have been told that the fair value of the plant is 4 lakhs. Rate of depreciation is 10%. So we'll say, okay, if the plant today is 2,70,000, this is after depreciation for the entire year. So if 100 minus 10 is 290, if 90 is 2,70,000, then at the start of the year, the plant must be 3 lakhs. However, that is at the start of the year. You have subtracted depreciation for the entire year. I need to compare it with the WDV on 1st October, and hence I will subtract the depreciation for 6 months, which is 15,000, and hence you get 2,85,000. You compare 2,85,000 with the fair value of 4 lakhs, and hence 1,15,000 will be debited over here, and hence there will be a balancing figure. It is not mandatory for you to pass the entries. However, it is mandatory for you to give the adjusting effects. So this is 3,25,000. Due to this 3,25,000, the value of land, building, plant, inventory, trade payables increase, but at the same time, there will be effect in the pre-retained earnings. It can go into the revaluation. However, Institute adjusts this against the retained earnings because it is pre. In any case, it will get cancelled. So over here, this is plus initial fair value adjustment to the extent of 3,25,000 approximately, which is going into the pre-section. However, post, are you told anything about the inventory? No. So we assume this remains unsold, and hence no other entry. Are you told anything about trade payables? No. So if you assume it is unpaid, no other entry. Have you been told anything about land? No, which means we assume it is unsold as well as not depreciated. However, for plant, there will be depreciation. So if there was a depreciation on plant based on fair value, this will be 4 lakhs into 10% into 6 by 12, that will be coming to 20,000. However, as per book value, the depreciation is 15,000 for 6 months, 30,000 for the entire year, and hence there will be an additional depreciation of 5,000, which will be P&L debit, the post P&L. This is for the period after acquisition and to plant. and as a result over here from this you will subtract the depreciation, which is to the tune of 5,000. After this all adjustments get done and hence you get the adjusted profits. The adjusted profits are actually 4,89,000, and out of 4,89,000 I can say 4 lakh, what is this, 92 and 325, 4,17,000 is pre and 67,000 is post. Out of this to RAM 60% is attributable, to NCI 40% is attributable. So 4,17,000 into 60%, this is 2,50,000. 200 minus 417, this is 166. 800, 67,000 into 60% is 40,000. 200 and 67,000, which comes to 26,800. So you will give all of these effects. This goes into working note 2, which is goodwill workings. This goes into working note 3, which is NCI. 40,300 goes into the working note 1, which is consolidated profits, and this goes into the working note 3, which is NCI. So over here this is pre-acquisition retained earnings. Please pardon me for my presentation at this stage. 2,50,000, 200 will go over here. 1,66,800 will go into the non-controlling interest. 40,000, 200 will be a part of the consolidated profits, and another 26,800 will be a part of the post profits of NCI. After you have done all of this, you have done all the analysis, you will try to total up every balance and then prepare the consolidated balance sheet. So these are the crucial steps or crucial adjustments pertaining to question number 1. Acha, next you have a question number 2, which was there in the Jan 21 paper. It's an interesting question which covers business combination as well as consolidation, and it covers NCI using fair value. So whenever NCI is using fair value, in such cases you will, when you prepare working note 2, you will take PC, that is investment, plus NCI minus 100% of the net assets. So whatever is the NCI at fair value as on the acquisition date, you will take that minus the fair value of 100% of the assets and liabilities. Okay, so we'll quickly glance through this question. Acha, on 1st April 17, A acquired 80% of the share capital of S. You are acquiring 80% of the share capital. On the acquisition date, share capital and reserves of S stood at 5 lakhs and 1,25,000 respectively. Okay, so this is 5 lakhs and 125. A Limited paid initial cash consideration of 10 lakhs. So this is cash paid. So you have been given on the acquisition date share capital and reserves. A paid initial cash consideration of 10 lakhs. Additionally, A issued 2 lakh equity shares with a nominal value of ₹1 each at a current market value of 1.8. So in the books of A, the entry must have been investment in S account debit, to cash 10 lakhs, to equity share capital 2 lakhs into 1, that is 2 lakhs, to securities premium, there is 0.8 in the securities, 0.8 into 2 lakhs, that is 1,60,000. So ideally the entry that you should have passed. Acha, over and above that, it is further agreed that A would pay a further sum of 5 lakhs after 3 years. A's cost of capital is 10% and the appropriate discount factors are given. The shares and deferred consideration have not yet been recorded by A. So this is an error. So ideally A should have passed the entry investment account debit, to cash, this is 10 lakhs, to equity share capital, this is 2 lakhs into 1, this is 2, to securities premium, this is 2 lakhs into 0.8, which is 1.6, and to deferred consideration, let us say, to deferred consideration, which is a financial liability. To deferred consideration will be how much? This will be 5 lakhs into 0.75. So this is 3.5 into 0.75. So this is 3.75. So this is 10 plus 2 plus 6, 1.6 plus 3.75, and hence this is 17.35. So investment should appear at 17.35 lakhs. However, it must be appearing at only 10 lakhs, which means there's a rectification entry that you need to pass, where you need to debit the investment by 7.35 and credit the share capital, securities premium, and deferred consideration. So over here, investment in S, if you look at it in thousands, this is 1,000. To that you will add 735. Acha, against that in share capital, you will further add 200. In securities premium, you will add a separate securities premium of 160, and you will have a deferred consideration, which will be recognized to start with at 375, but this will be adjusted as amortization happens. So this should be rectification in A's balance sheet, which should come. This is an error. A's balance sheet. Below is financial position of A and S on 31st March 19. Acha. Now in A's balance sheet, this should be recorded. See, investment remains at cost, will not change. 200 of share capital not change. Security premium not change, but the deferred consideration will very well change. So if you look at the deferred consideration, there will be an amortized cost working, for which you can do the working. So you will have 375. On that, EIR will be at the rate of 10% and hence 37.5. No payment and hence the closing will be 375 plus 10% will be 412.5. Next year, this is 412.5 into 10%. This is 41.25. And hence the closing is 453.75. So over the 2 years, you will recognize 37.5 and 41.25, that is 78.75 as a part of your expense. So your P&L or retained earnings will fall by 78.75, and at the same time your deferred consideration will increase by 78.75 and it will come to 453. Okay, so this is the rectified balance sheet of A if you were to apply financial instruments and business combination standard properly in your SFS itself. Acha, next, on the date of acquisition, the fair values of S plant exceeded the book value by 2 lakhs. So this is there on the date of acquisition. 2 lakhs in thousands is 200,000. The plant had a remaining useful life of 5 years. Acha, this is on the date of acquisition. The consolidated goodwill had been impaired by 2,58,000, whatever the goodwill comes, that is 258,000. A group values the NCI using fair value method. At the acquisition date, the fair value of the 20% NCI was 3,80,000. So this is 318,000. You are required to prepare the consolidated balance sheet of on 31st March. Notes to accounts are not required. So first you will do all of these rectification adjustments. Once they have been done, you prepare the Schedule 3 format. Notes are not required. So in the brackets only you can write the assets and liabilities workings, and then working note number 1. You can say for consolidated other equity. Acha, what is the only item of other equity over here? Retained earnings. There is also securities premium if you go to see. So there is retained earnings and there is securities premium. So this is adjusted balance. If you look at the adjusted balance of retained earnings in the books of A, this will be 1400 minus 78.75, for which a separate working will be shown. 1400 plus 78.75, as well as the adjusted balance over here will be 160. 1400 minus 78.75, and this comes to 1321.25. Acha, this is the adjusted balance. Next, you look at working note 2, which is on goodwill workings, which is different in this case because fair value method is followed for NCI. So this is investment. Investment over here is the adjusted balance of investment for an 80% stake, which is 1735, to which you will add NCI. NCI is 20%, which is at fair value, which is 380. Apart from that, on working note 3 as well, you will show NCI. This NCI at fair value on 1st April 17 will again appear at 380 rupees. Now, why will all of these items change? So we have taken the 380 worth of NCI. Acha, why will all of these items change? Well, we will have to analyze the reserves. So when you look at working note number 4, if you look at the analysis of retained earnings, the retained earnings are 300 rupees. Acha, apart from that, you look at share capital minus net worth. You will take 100% of the net worth over there because ऊपर अभी 80 and 20 दोनों आ गया, and hence equity share capital. Equity share capital, 100% of the share capital, which is 500, will be taken over here for the net worth. Now when you look at 300, retained earnings are 300, so you will first take the balance on 1st April 17, plus there will be profits. Profits will be from 2017 all the way up to 2019 minus dividend if any, and then you will have closing. Closing is 300, but at the date of acquisition profits were 125, and hence if there is no dividend, the balancing figure, which is 175, if you do the working between pre and post, pre में 125, post में 175, and as a result this is 125, this is 175. Acha, why will this get adjusted? Well, there are two particular items over here. First is there is a fair value adjustment, and hence your plant will be debited by 2 lakhs, and there will be pre-acquisition P&L credited by 2 lakhs. So this is plus initial fair value adjustment of 200, this will be added. Subsequently, there will be depreciation, so minus depreciation. So if you subtract the depreciation in the post section, this is 200 additional into 2 years have gone by out of 5 years, and as a result additional 80 rupees will be subtracted. Acha, apart from that there is goodwill. So whatever is the final goodwill that comes from that, you will have to write off impairment. How much is the impairment over here? 258. Now this impairment has to be borne by both parent and NCI. 258 now into 80%. This is 206.5 minus goodwill impairment. 206.4 will be against retained earnings, and NCI may again minus goodwill impairment. The remaining 51.6 will go against NCI because it is full goodwill, and hence goodwill impairment will be borne by parent and NCI both. Acha, now after this, if I were to total, this is what, 500 minus 80, so this is what, I think 420. If you analyze the 420, 375 and 95. Is it correct actually? 280, 125 plus 200, this is 325, this is 325 actually, and this is 95. Perfect. So over here this 325 is fully attributable to parent and NCI both, and this will directly go in working note 2 because pre-acquisition NCI as well as pre-acquisition share of parents profit is in working note 2. So this will be entirely, this is 100%. In a similar way, pre-acquisition P&L or retained earnings, 100% of that, that is 325 will come over here. Logically, even if you don't do this method, as per books, your share capital was 5 lakhs as on the date of acquisition, 1,25,000 was the reserves, over and above that 2 lakh rupees is the appreciation in the fair value, and hence 500 and 325 would be the total balance. Apart from that, the 95 may say you can take 80%, that is 76, which will be attributable to A, and the remaining 20%, that is 19, attributable to NCI. So over here this will increase by 19 due to the post acquisition profits. Again this will increase by 19 due to the post acquisition profits. This will increase by 76, and that's it. Once you do this working, this will be 825, and hence 1735 plus 380 minus 825 comes to 1290 minus 258 comes to 1032 will be appearing in the balance sheet, and NCI will be 380 minus 51.6 plus 19 is 347.2. This is the NCI appearing. The consolidated net worth will be 160, 1321.25 plus 76 minus 206.4 comes to 1190.85. If I total both of these plus 160, I get 1350. So if I just try to verify the three really crucial numbers in my balance sheet, I will have retained earnings at 1190.85, securities premium at 160, NCI at 347.4 or something, that's fine, slight rounding off here or there, and you will have goodwill at 1032. Perfect. Apart from that, every other asset and liability we can kind of total. Okay, so this kind of takes care of question number 2, and then the last question on the important sections of consolidation include the chain holding question. So there is this question involving P, S and SS. Here you have investment in 32 lakh shares of S in the books of P, 24 lakh shares in SS in the books of S. Apart from that, the entire balance sheet, and then you have P holding an 80% share in S and 75% share in SS. Their holdings were acquired on 30th September. Coincidentally, they were acquired on the same date. One of the institute problems has come where one of the holdings is acquired on 30th September, one of them is acquired on 1st of April. So you have to be careful in looking at the dates. On 1st April 11, the following balances stood in the books of S and SS. So you have reserves and retained earnings. 10 lakhs including the inventory figure of S is inventory which has been purchased from SS at a cost plus 25%. The parent company has adopted an accounting policy to measure NCI at the fair value applying IND AS 103. Assume market prices are same as their respective face values. So over here you have chain holding question. So in chain holding question, you again prepare schedule 3 balance sheet, you prepare the notes, but then you have to measure the NCI. So if you were to measure NCI in a chain holding question, you will say in the books of S, out of the 100%, how much is held by NCI? We would say that P owns 80% and hence 100 minus 80, that is 20% is held by the NCI in the books of S. But when I look at SS, things change a little. P holds 80% in S and S holds 75%, I guess, in SS, which means P's effective stake. P's effective stake in SS would be 80 into 75, that is 60%. So P's effective stake is 60%, which means the remaining is held by NCI. So over here, if P's effective stake is 60%, this is 80 into 75, in which case, let us say effectively this is 60%, then NCI would be 100 minus P's effective stake, that is 60%, and hence NCI over here will be 40%. This is the first thing you have to figure out. Acha, once you do this, then you have to do your regular workings where you have working note number 1, where you have your reserves and retained earnings. So first let us say you have reserves, then retained earnings. The balances would be 180 and 160. So there is reserves, there is retained earnings. Standalone P would be 180 and I guess 160. Acha, next is the important adjustment where you do working note 2, where you do the goodwill workings, where you start with the investment. Now when you start with the investment, this is investment of P in S and then investment of P in SS. Similarly, you do the NCI working note number 3, where you do the NCI working, and NCI working of S and SS, we say SS mein NCI is 40%, in S NCI is 20%. Acha, when you look at investment, one needs to remember that investment that P has in S appears in P's books and hence it is fully attributable to P only. So this is 340 entirely can come over here. But the trick adjustment over here is the second adjustment where you have 280. Now 280 appears in the books of S. One needs to remember that every asset in the books of S is attributable to P as well as NCI. It is not just attributable to P, it is attributable to both P and NCI, and hence 280 into. So if you take 280 into 75%, 280 into 80% is attributable to P. The remaining 20% is attributable to NCI. Every asset and liability in S Limited's books is attributable to P and NCI both. Yes, we will. Yes, we will. 280 into 80%, which comes to, let us say, 224, and hence the remaining. So basically the entry over here will be, if you were to eliminate the investment, you will debit the parent's share, you will debit the NCI. So NCI will be debited, so minus. We will say this is investment in SS. It is done by the NCI of S, and hence you will have the remaining 56 reduced from here. This is the adjustment where students do face a problem. After that, you will take NCI at fair value. Again, this is the NCI at fair value. Fair value is the same as the face value. So if you have the face value of these shares, this is 400 and 320. So 400 into 20% will come to 80, and 320 into 40%. 320 into 40% comes to 128. So these are the respective fair values. So this is 128 and this is 80, minus you will subtract your share in the net assets. This is 100% because you have taken PC plus NCI both. So equity share capital you will fully subtract over here. So this will be 400 and 320 fully adjusted over here, 400 and 320, and now you just have to analyze the reserves, and that is not very difficult. So over here, when you are analyzing the reserves, what will you do at the stage of analysis of reserves? You will figure out how much of these reserves, for example, when you look at S, we will see that the reserves of S are 100. Out of this 100, the opening balance was 80, which means 20 was earned during the year. Now the date of acquisition is 30th September, which means if 20 was earned during the year, half of the 20, that is 10 rupees, was earned pre-acquisition, half of the 20, that is 10 rupees, was earned post-acquisition. Similar is the case for retained earnings. If your closing retained earnings are 50, we will say out of the 50, let us say 20 was opening, which means the remaining 30 was earned during the year, 15 pre-acquisition, 15 post-acquisition, and you will attribute every number 80-20. In the books of SS, you will do the similar working, just that you will attribute every number in the ratio of 60 and 40, because all the share capital and reserves appear in the books of SS, and every reserve in the books of SS is attributable 60-40. There is also an upstream transaction, and if there is any unrealized profit arising from the upstream transaction, that will be adjusted against inventory, and the second effect will go against the profits. Okay, so I guess, this is the brief discussion of the important adjustments. So over here you have the working notes, let us say for SS, and you attribute 60-40, everything is taken in the ratio of 60 and 40. Okay, next you go to the joint arrangements chapter. There are a few, 2 or 3 small questions. We'll quickly wrap that up and then stop for a small break, definitely. So over here, the first question involves the application of proportionate consolidation method. So if there is a joint operation, you follow proportionate consolidation method. So this is on application of that. Second question involves equity method. So there is AB Limited and BC Limited. They have established a joint arrangement through a separate vehicle PQR. The legal form of the vehicle does not confer separation between the parties and the vehicle itself. So the legal form is such that it does not confer separation. So that means there is a, let's say something like a general partnership, and hence even if there's a general partnership, the partners continue to be directly interested in the assets and liabilities. Thus both parties have direct interest and obligations of the liabilities of PQR. So this is like a joint operation, not a joint venture. As neither contractual terms nor other facts indicate otherwise, it is concluded that the agreement is a joint operation and not a joint venture. That is correct. So this is a correct assessment. Both parties own a 50% share of equity in PQR. However, the contractual terms of the arrangement state that AB has rights to all of building number 1, 100% rights owned by PQR, and obligation to pay all of the debt owned by PQR to lender XYZ. So this is also 100%. AB and BC have rights to all other assets of PQR and obligations in the proportion of their equity interest 50-50. So everything else is 50-50. And as a result, how should AB record in its financial statements the rights and obligations of PQR? So in the financial statements, I will record 20 towards cash, 240 towards building, 100 towards building, another 240 towards the obligation, and 100 towards the liability. Now out of this 140, I would assume 50%, that is 70, would be contributed by AB. So in AB's standalone books, I will see an investment in PQR. However, in the consolidated books, when I take over proportionately all of these assets like cash account debit 20, building account debit 240, to building number 2 account debit 100, to debt owed 240, to equity obligation of let us say 50%, this will not be, this will be let us say 50. The balancing figure over here will be exactly 70. So basically, I will not again show the capital. In fact, whatever was the investment will be eliminated. Instead, I will show all of these assets and liabilities. So basically, cash, building 1, building 2, debt owed and equity benefit. All of these will be shown. The above assets and liabilities will appear in the balance sheet of AB. Further, AB's share in equity of PQR will be eliminated against the investment in PQR. Okay, so this takes care of your question number 1. Next, you have question number 2. B Limited acquired a 30% interest in D Limited, achieving significant influence. So there is a 30% interest which gives significant influence. The cost of the investment was 2,50,000. The associate has net assets of 5 lakhs at the date of acquisition, and the fair value of those net assets is 6 lakhs. So there is a fair value adjustment of 1 lakh, as fair value of PP is 1 lakh higher than the book value. This property, plant and equipment has a remaining life of 10 years. After acquisition, D has a profit of 1 lakh and paid a dividend of 9,000. D has also recognized exchange losses of 20,000 directly in other comprehensive income. So this is FCTR, which is a part of OCI. Calculate B's interest in D at the end of the year as per IND AS 28. So over here what will happen is, under the equity method, we will first start with the cost of the investment. So what is the cost of the investment? Cost of the investment was 2,50,000. Now within this, you will have to show goodwill separately if possible. How will you calculate goodwill? We will say that for a 30% stake, we ended up paying 2,50,000. However, the fair value of assets is 6 lakhs. So if the book value may be 5 lakhs, but the fair value is 6 lakhs, and hence for something which is worth 1,80,000, that is 6 lakhs into 30%, we ended up paying 2,50,000, and hence 70,000 over here is attributable to goodwill. So over here, if you had to calculate goodwill as a part of working note, you will calculate 70,000. Now why will this change? Well, this is going to change because your share in the profits. The question says, after acquisition, a profit of 1 lakh has been earned. Out of 1 lakh, 30% is our share, and hence 30,000 will be added. However, in calculating this 1 lakh, I would have taken the workings as per books. However, in the books, you had taken, let us say, assets at 5 lakhs only. But for our goodwill workings, we have taken assets at 6 lakhs, and hence there will be an additional depreciation to the extent of that 1 lakh. So minus, you will take your share of the additional depreciation. What is the additional depreciation? The additional depreciation over here will be, for example, 1 lakh divided by 10 years, so that is 10,000. But 10,000 में से हमारा share 30% है, and hence 3,000. This will be the additional depreciation because the goodwill is calculated based on that fair value. Separately, there is also dividend, so there will be share in the dividend. How much is the dividend? 9,000. Out of which we would have received 30%, and hence 9,000 into 30% would be, I think, 2,700. And then there is FCTR. Now this is a loss, so there will be a share in FCTR, which is also part of OCI, which is 20,000. 20,000 into 30%, which will come to 6,000. So if I take all of these, 2,50,000 plus 30 minus 3 minus 2,700 minus 6,000. Even FCTR is a part of OCI, that is a part of equity. So this will be 2,68,300, which will be the carrying value of the investment as per IND AS 28 under the equity method. You will add your share of profits, subtract share of dividends received. Also certain adjustments like OCI, if there is positive, you will add. If it is negative, you will subtract, because OCI also ultimately affects the equity. And the last question over here, this is a general question. It is not necessarily linked to, it is not necessarily just linked to your joint ventures. However, this has a lot of aspects: your other comprehensive income, your stake sale resulting in loss of control, investment retained, a lot of interesting things. So if I were to summarize what is going in OCI, there is reclassifiable OCI, non-reclassifiable OCI. Reclassifiable OCI means on the happening of certain events like sale or loss of control, the balance in the OCI to the extent of your share will be transferred to the statement of P&L. Reclassifiable OCI include FCTR, FVOCI debt instruments, hedging reserve as a part of cash flow hedge. Non-reclassifiable OCI includes revaluation reserve, includes remeasurement reserve for employee benefits, and it also includes fair value reserve for FVOCI equity. Whenever you lose control, you will remove assets and liabilities of the subsidiary. But if you remove assets and liabilities of the subsidiary and there was certain other comprehensive income linked to the subsidiary, now this other comprehensive income will now have to be reclassified to the statement of P&L if they are reclassifiable OCI, or transferred to retained earnings if they were non-reclassifiable. If some stake is retained, investment will be retained at the fair value, and if fair value is not given, then proportionate net assets value. We will apply that in question number 3. At the beginning of the current financial year, AB Limited holds 90% equity interest in BC. So AB Limited has control. During the financial year, AB Limited sells 70% of the equity interest. So 90 minus 70, it is now left with the 20% equity interest in BC to PQR for a total consideration of 56 crores. Okay, and consequently loses control of BC Limited. At the date of disposal, fair value of 20% interest retained by AB is 16 crores and net assets of BC are at fair value of 60 crores. Okay, so at the date when control is lost, you have been told that the fair value of the interest retained is 16 crores. So this is the value of investment, and the net assets of BC are fair valued at 60 crores. Okay. These net assets include the following: debt investments classified at fair value through other comprehensive income of 12 crores, FVOCI reserve of 6 crores, net defined benefit liability of 6 crores. Acha, so there are various items. What do we have to do? In the CFS of AB, 90% of the above reserves were included in equity reserve balances and 10% was attributable to NCI. So if NCI is removed, automatically the 10% share for these items are removed. As a part of the carrying amount of NCI, what would be the accounting treatment in case of CFS? Acha, so over here what happens is, in case of stake sale, you will remove the assets. So how much are you getting? Bank account debit. You are selling this stake, 70% stake, and you are getting a total consideration of 56 crores. So bank account debit 56 crores, against which you will remove the net assets. Net assets are worth 60 crores. This is 100% of the net assets removed, but then investment is retained. Achha, if net assets are removed, at the same point NCI, which is 60 into 10%, will also be removed, that is 6 crores. And investment will be retained. So there is nothing given about goodwill, so we will ignore the goodwill. 20% will be the investment. The question says it is at 16 crores. So basically 56 crores is what I'm getting, against which I'm removing the net assets of 60 crores. I'm removing the NCI. If there was any goodwill, I would have removed the goodwill as well. And I'm also retaining the investment, which means the balancing figure over here will be attributable to gain or loss. So to gain or loss on sale as well as remeasurement, 56 and 6 and 16, and this is 60, and hence there is an 18 rupees which is gain on sale as well as remeasurement. Aja. So when we do the working over here, this is 18 which is gain on sale and remeasurement. Now the problem is, once the assets and liabilities of subsidiary are eliminated, then you cannot continue to show the OCI items for that subsidiary, and hence they have to be reclassified. First, these net assets include debt investments classified as fair value through OCI of 12 crores and related fair value reserve of 6 crores. Now, when you remove the 60 crores as a part of the 60 crores, the 12 crore is already removed. However, what about the fair value reserve of 6 crores? Now, out of the 6 crores, 90% is attributable to parent and 10% is attributable to NCI. Now, when I remove the 6 crore worth of NCI, in that 6 crore, everything attributable to NCI is removed, which means whatever is the 90% is still must be appearing in the consolidated fair value reserve. So, over here, you will have to remove the consolidated fair value reserve from OCI and transfer it to the appropriate place. Well, this will be transferred to P&L because it is on debt, and hence debt is reclassifiable OCI. So 6 into 90%, that is coming to 5.4, will be transferred from OCI to the P&L because it was on debt investments which were in the subsidiaries books. Now subsidiaries assets and liabilities have been removed, and hence the reserves attributable to assets and liabilities should be appropriately transferred. Acha. Next, you have subpoint B. Net defined benefit liability of 6 crores has resulted in a reserve relating to net remeasurement losses of 3 crores. This is remeasurement reserve. So, what do you do with remeasurement reserve? Remeasurement reserve is a non-reclassifiable OCI. It is a debit balance. So on happening of certain events, you will transfer the remeasurement reserve directly to retained earnings. So over here, remeasurement reserve as a debit balance. So you will credit it, credit remeasurement reserve. This is 3 crores into 90% comes to 2.1, and hence the debit will go to the consolidated retained earnings directly. This is 2.7. So as you see over here, for 5.4 you will credit the P&L. For this 3 crores, you will debit the retained earnings because it is non-reclassifiable. On similar lines, if you look at third point, equity investments considered not held for trading. So at 10 crores, for which irrevocable option of recognizing in FVOCI has been availed, and related fair value reserve of 4 crores. So there's a related fair value reserve of 4 crores. So if equity investments are going out, the fair value reserve should also be removed. This is 4 crores, out of which 90% is our share, that is 3.6 crores. This is non-reclassifiable OCI, and hence you will debit the fair value reserve, credit consolidated retained earnings. So over here, fair value reserve debited, credited consolidated retained earnings, non-reclassifiable OCI. And last adjustment, net assets of a foreign operation of 20 crores and related FCTR of 8 crores. FCTR is a part of a reclassifiable OCI. So 4 items over here. Subpoint A, fair value reserve on debt instruments, reclassifiable. Subpoint B, remeasurement reserve on employee benefits, non-reclassifiable. Subpoint C, fair value reserve on equity investments, non-reclassifiable. And subpoint D, FCTR, reclassifiable. Which means over here, FCTR, 8 crores into 90% comes to 7.2. So this 7.2 will be transferred from FCTR to the statement of P&L. So FCTR into bracket OCI account debit to the statement of P&L. So over there, FCTR 7.2 and 7.2 is transferred to the statement of P&L. This is based on your stake sale understanding and your understanding about OCI, whether it is reclassifiable or non-reclassifiable. So this kind of takes care of joint arrangements as well. So by and large, we are left majorly with 115 and 116. So what we can do is we can stop for a break at this stage, and then we'll stop for around 10-15 minutes. So we'll let's say it's around 4:30 right now. Let's reassemble back by कितने minutes? 10 minutes में आ जाएगा, 15 minutes चाहिए अपने को. Can you tell why there's a provision for closure? We have taken tax base as 0 because income tax in that case used to tell you that you will get deduction only when paid, and hence income tax में entry नहीं मारा रहेगा. If there's no entry in income tax, the value in the tax balance sheet will be 0. ठीक है. So we'll start by 4:45. Come back in 15 minutes. Yes. I'll message once we start, but we'll be back by 4:45, please. Chalo, can you quickly confirm if the audio video is clear? Hello. Can you guys quickly confirm if the audio and video is clear? Okay. Chalo, we'll go to the last part of our revision session, which is on IND AS 115 and IND AS 116, which is on leases. So first we'll finish off IND AS 115, then we go to IND AS 116. So IND AS 115 is revenue from contracts. This is generally a slightly difficult standard. Questions have almost always come from this standard. We have also put a separate video where we have discussed all the past exam questions. So if you are short on time, just try to refer all of those past exam questions at least. And same is the case with IND AS 116. So revenue from contracts, where the standard requires a 5-step revenue recognition framework. First, you have to identify the contract from the customer. Second, identify performance obligations. Third, determine the transaction price. Fourth, allocate the transaction price to the various performance obligation. And last, recognize revenue. In the first step, when you are recognizing or determining whether the contract meets the accounting criteria, among other things, you have to be careful to figure out whether the obligations, rights, consideration, all of these have been clearly outlined and the consideration is expected to be receivable. When you determine performance obligations refers to promises which are distinct. Distinct over here refers to promises which give a separate benefit, and promises which are either separately identifiable or promises which are a part of separately identifiable. If the promises can be considered to be separately identifiable if they are not a part of a significant integration exercise, if they are not a part of a significant customization or modification exercise, and they are not highly interrelated. Next, you look at transaction price. Transaction price is the consideration that an entity expects to receive. It also includes variable consideration to the extent it is not constrained. If you believe that there's a possibility that the revenue, if you recognize now, there's a possibility that you will have to reverse it, it is considered to be constrained. In such cases, you do not recognize a variable consideration. In other cases, you do. Variable consideration can be recognized using the expected value method, that is the probability based weighted average, or the most likely outcome. Usually there's no written rule. However, if there are exactly 2 outcomes, you can take the most likely outcome. If there are more than 2, you can take the expected value if nothing else is given in the question. If the variable consideration is constrained, you will not take that into the determination of the transaction price. A few special cases include determination of sales in case of sale on return basis, where you will create a refund liability for the percentage of goods that you expect to return. For the balance, you will create a sale. Also, you will create a recovery asset. Separate provisions include special cases like warranties, where if there is an assurance linked warranty, then you will create a provision for warranty and no separate performance obligation. If it is a service type warranty, in which case you create a separate performance obligation for the warranty and the expenses to be recorded as and when they are incurred. Then you have significant financing component, where you will recognize the effect of time if material, that is, if the gap between the consideration paid and the performance obligation getting discharged is more than 12 months, then you will do a time value adjustment, provided it is not covered by the exceptions. That is, the gap should not be for a factor other than time. It should not be because of a goods which you are providing on a discretionary basis, and it should not be linked to a sales based royalty, in which case you will do the significant time value adjustment. For doing this adjustment, you will take the discount rate as the rate of a separate financing arrangement, and if that is not available, then you will take the internal rate of return, that is the IRR. Next, when you look at consideration payable to the customers, if this is for distinct goods or services, then you will look at the fair value. If the consideration to the extent of fair value, then you will recognize the expense. If there are no distinct goods or services, then the consideration will be reduced from the transaction price. Only the net amount will be shown. Then there are a few other cases as well, but the allocation of transaction price, will be based on the standalone selling price. You will allocate to the different performance obligations based on the standalone selling price, and standalone selling price is the observable price. If observable price is not available, you can take certain methods, like you can take the cost plus profit margin method, or you can take something like the comparative competitor's method or the residual method to find the standalone price. There are exceptions over here which can apply in case of discounts, or exceptions can also be applicable in case of variable consideration. Usually if there are discounts, you will not merely allocate discounts in the ratio of standalone selling price. If there is a smaller bundle to which a discount can first be attributable, then you will first allocate the discount to the smaller bundle, and then excess, if any, will be attributable to the larger bundle. Similarly, variable consideration, if the variable consideration is exclusively attributable to a particular performance obligation, you will attribute the variable consideration to that performance obligation as long as the principles of allocation are met, that is, it results in an entity getting what it reasonably expects. Next, when you look at the residual approach, the standard says that when you are applying the residual approach, you should ensure that you first allocate all discounts and then do the residual value working, and the residual value that you get should be an amount that an entity reasonably expects to receive on account of these transactions as well. There are a few special cases which involve customers' options for additional goods and services, like a customer loyalty points, in which case you will determine the fair value of the or the standalone selling price of the points and the standalone selling price of the products, and then allocate the transaction price in this ratio and then solve. The last step involves revenue recognition. When you finish all the 4 steps, revenue should be recognized when the control of the goods is transferred, and control can be transferred over time or at a point of time. Control can be considered to be transferred over time if there is a simultaneous transfer, that is, a customer receives and the entity renders. So there is a simultaneous transfer. The entity's performance creates something which is already an asset which is already in control of the entity. So you are doing a modification, etc., and the asset is already in the control of the customer. And lastly, if you are providing a service or goods which have no alternative use for the entity, and the other party has agreed to compensate you on the work done plus a reasonable profit margin, in such cases you will recognize the revenue over the period of time. If all of these conditions are not satisfied, then you will recognize the revenue at a particular point of time. Okay. Next, if the revenue is to be recognized over the period of time, you will have to measure progress. Progress can be measured using the input method, that is the cost incurred divided by total estimated cost, or the output method, where you will compare the fair value by, let us say, by an architect's report or a survey divided by the total overall fair value. There are certain adjustments that you might sometimes need to do to the input method if there are any major components or major costs where the entity's obligation is just to purchase and install it, in which case you will segregate the input method and do the workings separately. Like if you purchase a big elevator as a part of a large renovation project, then the cost of the elevator, you are just responsible for buying and installing the elevator. You keep it separate, do the recognition on a cost basis, and recognize the revenue and profit based on the stage of completion for the other costs. Okay. Revenue recognition, when the control is transferred at a point of time, will be recognized as revenue at that particular point of time. Then there are a few special cases like sale and repurchase agreement. So if there's a sale and repurchase agreement, then you will recognize revenue only if the control is transferred. If the control is not transferred, you can treat it as a loan or a lease transaction and accordingly solve. In case there is arrangements where you are billing and holding, in which case even if you bill and hold, that is, you have possession of the goods, as long as the control of the goods is transferred, you will recognize the revenue. Additionally, there may be a potential custodian or warehousing obligation that you might have, for which you will have to separately recognize revenue. Additional guidance has been added recently, for which we have hello, in which case it is considered to be a dynamic IP, and if it is a dynamic IP, then the revenue recognition happens over time. If it is a static IP, then the revenue recognition happens at a point of time. Okay. Special cases involve service concession, that is toll roads as well. Remember, in case of service concessions, it is not treated as a property, plant and equipment. In fact, if you have a contractual right to receive cash, it is treated as a financial asset. If you just have a right to collect toll or to operate, then it is treated as an intangible asset. Okay, if there is a contract modification, we have to see that is the modification resulting in additional goods at the standalone selling price, in which case it is treated as a separate contract. However, if there are no additional goods or if there is no standalone selling price, then it is treated as contract modification, in which case if there are any distinct goods or services which have been agreed, even if there is a distinct performance obligation, then you treat it as cancellation of the existing contract and creation of a new contract for those distinct services. On the other hand, if there is no distinct goods or services, modification is for a single performance obligation which is not distinct, in which case you will treat it as a cumulative catch-up adjustment, which means you will try to find the revenue till date using the revised method minus the revenue already recorded. That will give you the revenue to be adjusted. Acha. Then there is a working, let us say, for contract cost. There are two types of costs. There is contract acquisition cost and fulfillment cost. Acquisition cost is a cost that is incurred in order to get the contract. That is, that cost will not be incurred if the contract is not obtained, will be incurred only if the contract is obtained. On the other hand, contract fulfillment cost is a cost which is to be incurred to fulfill the terms and conditions of the contract. If the contract term is more than 12 months, then contract acquisition cost and fulfillment cost, which is not covered by a separate accounting standard, is allowed to be capitalized and deferred over the expected contract term. If the contract tenure is less than 12 months, then such capitalization and deferral is not really permitted. Okay, so that kind of broadly takes care of IND AS 115 concepts. You next go to IND AS 116 related concepts. So as per IND AS 116, there is a lease. Lease requires the existence of an identified asset, and on that identified asset you should get a right to control or direct use for a specific period of time in exchange for a consideration. So we need to understand what do you mean by an identified asset. Under an identified asset, an asset has to be physically distinct. If it is capacity driven, then substantially all of the capacity should be attributable to you. It has to be physically distinct, and the supplier should not have a substantive substitution right, which means the supplier cannot substitute, in which case it can be said that you have an identified asset. If you have an identified asset, then it will be treated as your right of use asset if you have the right to control and direct use. Control and direct use would mean you might not really own the asset. However, you are likely to get substantially all of the benefits directly or indirectly on using that asset, including the indirect benefits like subletting as well. Substantially all of the benefits flow to you, and important decisions on what and for what purpose the asset is going to be used, how and where to use the asset, all of these important decisions are taken by the entity. In such case, it is said that you have a right to control and direct use. It is not necessary that you have to manually use the asset. You can instruct others who are actually operating the asset as well, as long as you have the ability to order the person operating the asset to use the asset in a particular way. It is said that you have the right to direct use. Secondly, there is lease and non-lease component. So should you separate out the lease and non-lease component? Well, it depends. If there are multiple lease components, like there are multiple identified assets, for example, there is building, furniture, electronic equipment, all of these are actual assets which have different right of use, in which case you should ideally record them separately unless they are highly interrelated. If they are highly interrelated, you will not record them separately. In other cases, you will have to record them separately unless they are highly interrelated. Achha. So the separation of lease and non-lease components, you will separate out the lease components if they are not highly interrelated. For the non-lease components, like for example driver who is operating or maintenance of a building, these are not backed by an identified asset, and hence they are non-lease components. Non-lease components ideally should be separated. However, there is a practical expedient or a conditional shortcut which is available, which allows you not to separate for these non-lease components as well, as long as you have a choice. However, if nothing is given, you will assume that you will separate out the lease as well as non-lease components. For the lease components, you don't have a choice. You will have to separate if they are not highly interrelated. For the non-lease components, if you don't want to separate, you may not separate it. Then you will treat it as a part of a single arrangement. Certain expenses like administrative expenses, etc., is either neither lease nor non-lease components. They will just increase the overall transaction price. We will allocate the transaction price between the lease and the non-lease components, and also between the individual lease components in the ratio of their standalone price. Standalone price is the price that will be charged if the transaction was to be done on a standalone basis. If there is no information about the standalone observable price, then you can take the fair values as well. A few crucial terms in terms of lease calculation would be, there is inception date. Inception date refers to the date when the lease agreement is entered or commitment by the two parties, whichever is earlier. Commencement date is the important date when the accounting starts. That is the date when you get the right of use, irrespective of when the payment starts. The date when you get the right to use the asset is the commencement date, that is when the accounting starts. Two important terms include lease terms and lease payments. In case of lease term, it includes the non-cancelable period plus renewal period or cancellation period if there's a significant economic incentive to renew and not cancel, in which case the renewal period will be taken, otherwise it will not be taken into the lease term calculations. When you look at lease payments include fixed lease payments, including in substance fixed lease payments minus lease incentives. Second, it will include variable lease payments only if they are linked to a rate or an index. Otherwise, other variable lease payments are not included in the lease payments for the purpose of calculation of lease liability. Third, guaranteed residual value or purchase option which is likely to be exercised will be included, or if there is cancellation which is likely, then the cancellation penalty which is likely to be paid will be taken as a part of the lease payments. Only in this case you will take the variable payments which are linked to rate or index. If it is other than linked to rate or index, it will go directly to the P&L, will not go into the lease liability calculation. Further, payments which are attributable to non-lease components, if they have decided to shown separately, will also not be a part of lease payments. Variable lease payment linked to rate or index would be payments which are linked to, let us say, CPI index or a LIBOR rate, etc., in which case you will take the LIBOR or CPI rate at the commencement date, and then you will change it only when there is an actual change in the cash flows. Till that date, you will not keep on changing. Once there is an actual change in the cash flow due to resetting, then you will remeasure the lease liability. In other cases, if the variable lease payment is not linked to a rate or index, then whatever is a variable lease payment will go to the profit and loss account. Acha. Initial direct cost will be adjusted along with your lease payments in order to find, in case of lessor, the IRR. Discount rate will be first preference, the rate which is implicit in the lease, that is the lessor's IRR, and if that is not available, then the lessee's incremental borrowing rate. There are certain recognition exemptions which are available in lease, that is in case there is a short-term lease, that is lease of 12 or less than 12 months, or if it's a lease of a low value item, in which case you may not prepare the ROU asset and the lease liability. In fact, you can directly show the rent expense. However, in all other cases, you will have to show the right of use asset with the corresponding lease liability. This right of use asset and the corresponding lease liability. How do you calculate the lease liability? Lease liability is calculated as the present value of the future agreed lease payments over the lease term, discounted at the rate which is decided as per the key terms. So this will be your lease liability based on the future cash flows. Now, ROU asset will obviously usually be equal to the lease liability because that is the cost you are paying to get the right of use. Over and above that, you will also include initial direct cost, also include lease payments that are done before the commencement date, subtract lease incentives before the commencement date, and if there is any present value of site restoration, even that will be considered for right of use asset. Subsequent accounting for lease liability will be done in a manner which is similar to financial liability. So you prepare the amortization table where you increase the lease liability by the effective interest rate, reduce it by the lease payment to get to the closing balance. And in case of a right of use asset, subsequent accounting will be after considering the depreciation or impairment as it applies to IND AS 16. In case there is foreign exchange which comes along with lease liability, remember lease liability is a monetary item whereas ROU asset is a non-monetary item. Lease liability will be remeasured at each closing rate. ROU asset continues to be at the historic rate. Acha. Now, when can a lease liability potentially change? Well, lease liability can change if there is a change in or if there is unwinding, there is lease payment, or if there is a remeasurement, that is if there is if lease payment was linked to LIBOR and LIBOR changes, or there is a renegotiation, that is a lease modification, in which case lease liability will change with the corresponding adjustment to the right of use asset. Now, this is broadly accounting discussion in the books of the lessee. In the books of the lessor, the accounting as it was done in your AS continues to be retained. There is still a classification of operating and finance lease. Finance lease is a risk where substantially all risks and rewards incidental to ownership are transferred to the lessee. Finance lease can be if ownership is likely to be transferred, or there is a purchase option which is likely to be exercised, or if the lease term is a major part of economic life, that is 75% or more, or present value of lease payment substantially cover the fair value, there is more than a 70%, more than a 90% chance. This is what is a finance lease. All other leases are operating lease. In case of finance lease, in the books of the lessor, you will usually derecognize the asset and create a lease receivable. This will be created at the net investment in the lease. Net investment is calculated as the present value of lease payments plus the present value of unguaranteed residual value. Gross investment is the total lease payments plus the unguaranteed residual value. Unearned finance income is the difference between gross investment and the net investment. At every subsequent accounting, you will recognize finance income and you will recognize the receipt of cash. Since you have derecognized the asset, there will be no other entry. In case of operating lease, you will not derecognize the asset. In fact, you will recognize the income on a straight line basis unless there is any other systematic basis which is evident. And hence, because the asset is not derecognized, the depreciation on the asset will continue to be appearing in your books. Acha. So, a special case over here can involve the manufacturer or dealer ledger. There's one problem which is there in the institute study material, which has also been modified and has come in one of the RTPs as well. So I would rate that as slightly important because institute has not yet asked. It's a little illogical to at some points, but that is one of the things which has not been asked clearly by the institute. So just go through that problem and remember the adjustments and proceed. In case of manufacturer or dealer ledger, because you are manufacturing or dealing, you will also have to recognize sales and COGS. So you recognize the lease receivable at the net investment, you will probably derecognize the asset, but then you will also have to recognize sales, which is to be recognized at, let us say, the fair value minus the present value of unguaranteed residual value, because you have not yet realized or committed for receiving the unguaranteed residual value, and correspondingly COGS will also be the cost of the asset minus the present value of unguaranteed residual value. That is what has to be done in case of a manufacturer or a dealer ledger. Special cases over here involve sublease, which is not very important, and then sale and leaseback, which is slightly important. So when you look at sublease, you will try to figure out whether in the books of the intermediate ledger, who is also the intermediate lessee. So over here in sublease, there's a head lease where, let's say, P gives an asset on lease to S and S gives it to S2, for example, in which case the first lease is a head lease, the second lease is a sublease. In the intermediate lease, in the books of the intermediate party, he is also a lessor and the lessee. So over here, when he takes the asset on rent, he will create an ROU asset, but when he gives it out on rent, should he derecognize the asset or should he continue? It depends on whether the sublease is an operating lease or finance lease. If the sublease is operating lease, you will continue to show the asset. If it is a finance lease, you will derecognize the asset. For evaluating that, you will not look at the life of the asset. In fact, you will look at the remaining lease term for determining whether it is a finance lease or an operating lease. When you look at sale and leaseback, in this case, you will first see whether the sale and leaseback results in a control being lost or control not transferred. If control is not transferred, it is a pure loan transaction. But if control is transferred, then you will have to do slightly detailed accounting, where you will first have to see whether the sale and leaseback is happening at market terms or off market terms. If the selling price is equal to the fair value, then the transaction is at market. If selling price is greater than the fair value, then there is a hidden loan. If the selling price is less than the fair value, then there is a hidden prepaid lease payment. So the difference between the selling price and the fair value can be taken as a hidden loan or a prepaid lease payment. If it's a prepaid lease payment, you will adjust it against ROU asset. If it's a hidden loan, you will show it as a separate lease liability. The steps that you will have to follow is, once you find the off-market element, then you will look at the present value of agreed lease payments and find the present value of dedicated lease payments. So if your present value of agreed lease payments is 14 lakhs and the loan component was 3 lakhs, we are saying that if in today's terms I have to pay 14, out of which 3 will be towards loan, then 11 lakhs is the present value of dedicated lease payments. You will compare the present value of dedicated lease payments with the fair value of the asset to figure out how much percentage of the assets rights are you still retaining, because if the asset today is worth 27 lakhs, then if you are agreeing to pay 11 lakhs in today's terms for an asset which is worth 27 lakhs, then 11 upon 27 approximately, that comes to 40% of the rights of the assets you are retaining, and hence you will not recognize any gain or loss to the extent of that 40%. However, for the remaining 60%, you can recognize gain or loss. Further, the ROU asset will be recognized based on the proportionate carrying value. Like if a day before the proportionate carrying value for the entire asset was, for example, 20 rupees, then if 40% of the rights are retained, then 20 into 40% will be the value at which you will show the ROU asset. Lease liability will be based on the present value of the dedicated lease payments. Institute sometimes clubs the financial liability and lease liability because subsequent accounting appears to be broadly similar. Lease modification and lease remeasurement. Lease modification can be done in the books of the lessee. Modification arises if you were to change the lease rent payment, or if you were to change the lease tenure, or you were to change the scope, that is the area, etc. covered. Usually if there is an increase or decrease in lease rent, or if there is a increase in the lease tenure, or if there's an increase in area, there's just an increase, so you're getting an additional right of use, or the existing right of use has become more expensive or cheaper, in which case there's no gain or loss to be recorded. You will just try to calculate the lease liability, the revised lease liability on the date of modification using the modified cash flows and the modified rate of return. Compare it with the existing ledger balance, adjust the lease liability with the corresponding effect on ROU asset. However, if there's a decrease in the lease tenure or decrease in the area, then there is a partial derecognition, and hence you will have to calculate the gain or loss, for which you will have to find proportionate carrying value of the ROU asset that is derecognized and the proportionate lease liability that is to be derecognized, and hence the balancing figure will be gain or loss. How to do that proportionate? There are a couple of questions in the institute material. However, they have used slightly inconsistent workings. We will do the workings in a manner which was done by the institute. And then if there is any revised lease liability, adjust that revised lease liability against ROU asset. So usually, unless there is a decrease in scope or decrease in area or both, you will usually just find a modified lease liability, compare it with the ledger balance, and the difference will be adjusted against lease liability with a corresponding effect to ROU asset. However, if there is a decrease in lease term or decrease in area or both, you will have to find a proportionate carrying value of lease liability and ROU asset, and then take the difference in the gain or loss in the P&L. Acha, this is in the books of the lessee. We have also given certain steps. This is lease modification. Lease modification arises if there is a renegotiation which is agreed, and then there is lease remeasurement. Remeasurement arises if there is no renegotiation. However, the terms of the contracts were such that the lease liability can change. Like, for example, there was likely that the purchase option is there, and now it is likely that the purchase option will be exercised. Or if there was a lease term where there was a renewal option, earlier you thought it will not be exercised, now you think it will be exercised. Or there are other cases like variable lease payment linked to rate or index, in substance fixed lease payment, residual value guarantee, etc. In these cases, if there is a lease remeasurement, if the remeasurement is happening due to changes in lease term or possibility of exercise of purchase option, then you will take the revised discount rate. In other cases, you will take the original discount rate. If there is more than one factors, let's say the lease term is changing and the variable lease payment is also changing due to rate or index, then you will again take the revised lease discounting factor. You will continue with the original discounting factor only if it arises exclusively due to one or all of these factors. Acha. Then there is lease modifications, impact due to COVID-19. I would not really put any weight behind this because these modifications by and large expire by 30th June 2022, and as a result, I don't really think that, I mean, you can safely even skip this, even if you are broadly aware. I mean, just for conceptual understanding, this was a lease modification where there was a shortcut given in certain cases during COVID-19 for lease modifications done whose benefits extend up to 30th June 2022, which is unlikely to come in your exams. Acha. Next, you have modification in the books of the lessor. In the books of the lessor, over here, if there's an additional right of use which is at the standalone selling price, you treat it as a separate lease. In other cases, you treat it as modification of lease. So if there's an existing finance lease, you will see if the modified terms were applicable at inception, will it still be a finance lease? If the answer is yes, then you will remeasure the lease receivable. However, if you now believe that it will no longer be a finance lease, then you will derecognize the lease receivable and create and bring back the underlying asset at the same value. So you will derecognize the lease receivable and bring in the underlying asset. However, if this is a modification for operating lease, then you will treat it as termination of the existing operating lease and starting of a new lease with the revised lease terms. Okay, transition approaches I would again say as not really important from an exam perspective. Okay, so we will try to address questions on this. So CSR is also there, but I think we'll first finish 115 and 116. So let us say you have page 89. See, most of these questions are ICI main exam questions. So, question number 1. Acha, we'll first go to question number 2. Question number 2 on page number 92. An entity regularly sells products X, Y and Z individually, thereby establishing the following standalone prices. So there are 3 products, 1,20,000. In addition, the entity regularly sells Y and Z together at 50,000, which means there's a smaller bundle for Y and Z. If you sell them together, actually it is 70,000. However, the entity is selling at 50,000. So there's a discount of 20,000, which is attributable to smaller bundle of Y and Z alone. Case A, entity enters into contact with the customer to sell X, Y and Z for 1 lakh, which means for all the 3 products, I'm giving a discount of 20,000, but that 20,000 is attributable largely to Y and Z only. In exchange, the entity will satisfy performance obligations at different points or same point of time. That is fine. So what will we do? We will allocate the discount first to Y and Z. So 20,000 of discount into 25 by 70 and 20,000 of discount into 45 by 70. You will allocate these discounts to only Y and Z. No allocation will happen to X, and after deducting this discount, you will find the transaction price. In case B, entity enters into contact with customers to sell X, Y and Z as described in case A. The contract also includes a promise to transfer alpha. The consideration in this contract is now 1,30,000. Earlier it was 1 lakh, now it is 1,30,000. The standalone price of alpha is highly variable because the entity sells alpha to different customers for a broad range of amounts, that is between 15 to 45,000. Determine the standalone selling price of X, Y and Z and alpha using a residual approach. So what will you do? We will first find what is the allocation in case A, that is 50,000, 17,857 and 32,153. This is the allocation for 1 lakh. Now, if product alpha is also added, your total transaction price becomes 1,30,000 and hence the balancing figure after allocating discounts is 30,000, which is attributable to alpha, which is within the range of prices, that is 15 to 45 that the entity usually expects for alpha. Residual approach is inappropriate. The same facts as B apply. However, the transaction price is 1,05,000. In such cases, the balancing figure will be taken as 5,000. Now, this 5,000 is not appropriate because the entity reasonably expects anywhere between 15 to 45 for alpha, and hence we will have to use alternative valuation methods. This method does not apply. Achha, then you have question number 3. Over here, this is on customer loyalty points, for which again all of these questions there is a separate video you will find if you want in detail. We are just doing a brief discussion here. Now, KK runs a departmental store which awards 10 points for every purchase of 500, which can be discounted by the customers for further shopping with the same merchant. Each point is redeemable on future purchases of KK's products within 3 years, and value of the point is rupees 0.5. This is the value for each point. Acha, what is the question asking you? From the first part, it says, how will the recognition be done for sale of goods worth 10 lakhs on a particular day? Acha, if there are goods worth 10 lakhs which are sold, then how many points would be allotted? 10 lakhs divided by, let us say, for every 500 worth of shopping, 10 points are given. So 10 lakhs divided by 500 into 10, so that is 20,000 points, and each point is actually worth 0.5, and hence 20,000 into 0.5, that is 10,000 rupees is the fair value of the points. So basically, on a sale of 10 lakhs, the entity is under an obligation to give products worth 10 lakhs and points worth 10,000, and hence your allocation of the transaction price, that is 10 lakhs, will be to the goods and to the points in the ratio of 10 lakhs is to 10,000. So 10 lakh upon 10 lakh 10,000 will be attributable to goods, and 10,000 upon 10 lakh 10,000 will be attributable to points, and as a result you will have to pass the entry bank account debit 10 lakhs to sales, for example 9 lakh and something, to customer loyalty point liability. Why? Because I'm under an obligation to give the goods or services later against those points when the customer comes. So over here, in the first case, if you go to see bank account debit 10 lakhs to sales 9,90,000 to liability for customer loyalty program. Acha, in the given case, during the accounting period 17-18, entity awarded 1 crore points. This is given to various customers, out of which 18 lakh points remained undiscounted to be redeemed till 31st March 2020. So there is a 3-year time frame. The management expects only 80% of these remaining points will be discounted in the future. So what does the management do? The management in this case expects at the end of the period that only 80% of the points will remain. How should the redemption transaction be recorded for the year 17-18? The company has requested you to present the sale of goods and redemption as different transactions. Sales are 5,000 lakhs. So you will allocate 5,000 lakhs against 5,000 lakhs of sales. There will be 1 crore points. Each point is worth rupees 0.5, and hence 50 lakhs will be the fair value of the points. So value of points is 50 lakhs. You will allocate 50 crores that you are going to get in the ratio of standalone selling prices, that is 50 crores into 50 lakhs, that is 100:1, in which case 50 crores and you will create a CLP liability. CLP liability, out of the CLP liability, we are saying 18 lakhs remain undiscounted. That means the remaining 82 lakhs must be discounted. Now 82 lakhs usually would be out of 1 crore. However, the management expects that only 80% of the remaining points will be discounted. So out of 18 lakhs, only 80% will be discounted, and hence only 14.4 lakhs remaining points will be discounted. So we can say that the points which are actually redeemed are 82 lakhs out of the total 96.4 lakhs which are going to be redeemed. So over here you will have total 96.4 lakh points, out of which 82 lakhs have been redeemed, and hence the revenue will be recognized to the extent of 42.11 lakhs. Remaining will be shown as deferred revenue. The same process will continue in the next year as well, and then in the last year. Ultimately, whatever is the balance lying in the CLP liability will be transferred to revenue, because irrespective of the points being redeemed or not, customer had originally paid you consideration. So in the last year, whatever is remaining will be transferred to revenue. Acha, that is question number 3. Going to question number 4. In this case, there was a fixed fee contract of 1 million. So that is a part of transaction price. Estimated cost to complete is 9,50,000. So it's a profitable contract. The entity will transfer control over 5 years and uses a cost to cost input method for the progress. An incentive award is available where, depending on weights, there are various incentive fees. If you read this paragraph, both of these paragraphs, it will tell you that the entity believes that it is most likely that this incentive fee will be earned. In years 1, 2 and 3, its estimate is that it is most likely that you will earn this incentive fee. So based on the analysis, entity believes 10% to be the most likely. So here you are not going to use probability based weighted average, you are going to use the most likely method when estimating the transaction price. Therefore, entity includes only 10% award when calculating revenue and concluded it is probable that a significant reversal will not occur. So this is variable consideration which is not constrained, and hence in years 1, 2 and 3, your transaction price will be 1 million, that is 10 lakhs plus 1 lakh, most likely value, and hence the transaction price will be 11 lakhs in the first 3 years. Acha. Next, the entity reassesses the production to determine whether it is on track to meet the criteria. At the end of the 4th year, this is in 4th year, it becomes apparent that the contract will fully achieve the weight based criteria, and therefore entity revises its estimates of variable consideration to include the entire 25%. So now in years 4 and 5, your understanding is that you will get 25% incentive. So your transaction price in years 4 and 5 calculation will be 10 lakhs plus 2.5 lakhs, and hence this will be 12.5 lakhs. Acha. Evaluate the impact of changes in variable consideration when the cost incurred is as follows, that is 50,000 in the first year. So if I look at the cumulative cost, that is 50,000, 2,25,000, 6,25,000, 9 lakhs, and then 9,50,000, and hence you can find the percentage progress on cost incurred, that is 50 upon 950, then 225 upon 950, 625 upon 950, and so on. So this will give you the stage of completion, and your transaction price, that is 11 lakhs into the stage of completion, will give you the revenue till date minus the revenue earlier recorded, and that will give you the profits. So there are various ways in which you can solve. One is you can find the stage of completion, find the different transaction prices, and then you will say that okay, the revenue to be recognized will be based on the stage of completion 11 lakhs, 11 lakhs, 11 lakhs, and then 12,50,000, 12,50,000 minus revenue earlier recorded, cumulative cost, and that will be giving you the profits. So ICI has solved it in a slightly different manner, but ultimate answer is the same, so you can solve it using either of these methods. Next we have question number 5. Now question number 5 is again a past exam question where there is a company A which is in the business of manufacturing engineering machines and providing after sales service. The company entered into contact with Mr. Anik to install a machine, that is PI, on 1st April 18 and to service this machine on 30th September 18 and 1st April 19. The cost is 1,60,000. For the entity, cost on the machine is 1,60,000. It is possible for a customer to purchase both the model and maintenance service separately. Mr. Ranik is contractually obliged to pay 4 lakhs on 1st April. So he is going to pay 4 lakhs on 1st of April, and the prevailing rate for 1 year credit is 5% for 6-month period. It is not 5% per annum, it is 5% for 6-month period. This is the rate that they are charging. So there is no hidden per se, there is a rate that is being charged. As per the experience, servicing of the machine is expected to cost 30 in the first service, 50 in the second service. Assume actual cost equal expected cost. When A provides machine to customers in a separate transaction, it earns a 50% margin on cost. On 1st April 18, the cash selling price of the machine is 2,51,000. So over here, what is asked? You are asked to segregate the various components. So we will say in such a case that for model PI, the standalone selling price for the machine, is 2,51,927. The standalone selling price for the first service is 50,000. Kitna hai kharcha? First service is, I think, 30,000 plus a 50% profit margin. So this is 45,000, the standalone selling price. For the second service, this is 50,000 plus 50%. So this comes to 75,000. And apart from that, so Mr. Ranik is agreeing to pay you 4 lakhs. Why is he paying 4 lakhs? Because probably 5% for every 6 months is a regular credit. So ideally, if I give you the machine immediately, you have to pay me 2,51,000. You are not paying me 2,51,000. So for this 2,51,927, I will ideally charge you interest. Question tells you at the rate of 5%. So this is 251,927 into 5% comes to, let's say, 12,596. You don't even pay me after 6 months. In fact, you take more service from me. So over here, on account of servicing, you have to pay me a further 45,000, and hence your ideal closing balance will be 251,927 plus 5% plus 45,000 comes to 3,09,523. So ideally for the second half year, 3,09,523, on which another 5%, which is 15,476. There is no servicing done as yet, and hence your total amount will be 3,09,523 plus 5%, which will be approximately 3,25,000. Now at the start of the next year, 3,25,000. By the start of the year, another 75,000 is attributable to the servicing. So 4 lakh is there, and the entire 4 lakh is paid, which means over the 2.5 years, the total interest is 12,596 plus 15,476, which comes to 28,072, and hence we will say that for the finance income, 28,072. So if I total up all of these, I will get 4 lakh rupees. So this is the breakup. When will the revenue for 2,51,927 be recorded? As and when machine PI is delivered. When will the servicing revenue be recognized? After 6 months for 45,000 with the cost of 30,000. After 12 months, that is on 1st April, for 75,000 with the cost of, let us say, 50,000. And the finance income of 12,596 and 15,476 will be recognized over time. So over here, you are required to segregate the components of transaction that A shall apply to revenue, calculate the amount of revenue which it must allocate to each component. So there are 4 components. There is sale of machine, there is first service, second service, and then there is finance income. 2,51,000 to the machine, approximately 45,000 to first service, 75,000 to the second service, and 28,072 to interest income. You will pass the journal entries and then recognize an extract showing how much revenue will be recognized. So apart from 75,000, which is recognized in the next year because service is rendered on 1st of April, everything else will be recognized in the first year only. Achha, there was one more question, question number 1. We will also kind of quickly discuss this. There are 2 possible ways in which you can solve this question. ABC Limited supplies plastic buckets to wholesale customers. As per the contract between ABC and the customer for 1920, price of the plastic bucket will decrease retrospectively as sales volume increases. Okay, so there are price per units and sales volume. You are required to suggest how much revenue should be recognized in the books of accounts as per the expected value method, considering a probability of 15, 75 and 10 for sales value of 9,000 units, 28,000 units and 36,000 units. So over here you will try to find the expected number of units, which is calculated as 15% into 9,000 plus 75% into 28,000 plus 10% into 36,000. You will find the expected value of expected units, and at each of these levels you will try to find the sales. Like at 9,000 the sales value would be 90, at 28,000 the sales value will be 80, and at 36,000 the sales value will be 70. So what you will try to do is you will find the expected units and you will also find the expected sales value, and once you find the expected sales value, the expected units, divide the two to find the selling price per unit. For workings, assume that ABC will achieve the same number of units during the year as initially expected under the expected value method. So what institute has done over here is it has found the expected units, as we said, as 25,950, the expected sales as 20,53,000, and hence the average price they have taken as 79.13 and done the entire working based on 79.13. Second, in case ABC decides to measure revenue based on the most likely method instead of the expected value method, so the most likely method will be 75% chance, that is 28,000 units ही होगा. How will the revenue recognized in the books of accounts be based on the available information? Then you will do the working based on 28,000 units, and for those 28,000 units at the rate of 80 per unit. For workings, assume ABC will achieve the same number of units, that is 28,000, to the customer as initially estimated under the most likely value method, and then you are asked to pass the journal entries. So this is regarding the expected value as well as the most likely value method. There are different ways in which this question can be kind of addressed. Next, you go to leases. Now, in case of leases, there are a few problems. We will discuss that. Go to page number 103. Now, company EFG enters into a property lease with entity H. Initial term of the lease is 10 years with a 5-year renewal option. The economic life of the property is 40 years, okay, and the fair value of the lease property is 50 lakhs. EFG has an option to purchase the property at the end of the lease term for 30 lakh rupees. So there is a purchase option in this case. The first annual payment is 5 lakhs with an increase of 3% every year thereafter. So this is a fixed payment, 5 lakhs plus 33%. The implicit interest rate is 9.04%, and H gives company EFG an incentive of 2 lakhs payable at the beginning of year 2. So here the incentive is payable at the beginning of year 2. So institute has kind of assumed that all the other payments are also paid at the beginning of the year. An alternative assumption can work, which is to be used for normal tenant improvement. EFG is reasonably certain to exercise the purchase option. Okay, that means the 30 lakhs of cash outflow will also be taken. How would EFG measure the right of use asset and lease liability over the term? So to start with, you will first try to find the lease liability. Lease liability is the present value of the future cash flows. Like 5 lakhs is the cash flow plus 3%, plus another 3%, plus another 3%. You do the working for all the 9 or 10 years, and then at the end you will have 30 lakhs. Apart from that, there is a lease incentive. Lease incentive will be reduced. Lease incentive is I think 2 lakh rupees at the start of the second year. So you will reduce that, and considering that, you will try to find the total payments. This will be your total payments. This is, I think, in the first year, this is 5 lakhs, not 5 lakh 50. So this is 5 lakhs, and you will have total lease payments. The number you get is approximately 50 lakhs. So at initial recognition, you will have ROU asset worth 50 lakhs and a lease liability worth 50 lakhs. Here, if you had to do subsequent workings, you will prepare amortization table considering 50 lakhs, and you will also depreciate the ROU asset over a 40-year life, not over a 10-year life, because it is reasonably certain that the purchase option will be exercised. Okay, so this is question number 1. Then you have question number 2, which involves manufacturer lessor. So over here, lessor enters into a 10-year lease of equipment with the lessee. The equipment is not specialized in nature and expected to have alternative use at the end of 10-year term. Under the lease, lessor receives annual payment of 15,000 payable at the end, expects residual value of 50,000 at the end. Lessee provides residual value guarantee that protects for the first 30,000 of the loss at a price below the estimated residual value. So 30,000 is kind of protected. The remaining 20,000, I guess, is unguaranteed. The equipment has an estimated remaining life of 15 years. Out of 15 years, lease term is 10 years with a carrying amount of 1 lakh and a fair value of 1,11,000. Lessee the lease does not transfer ownership of the underlying asset to the lessee at the end of the lease term or does not contain an option to buy. So you will have to figure out whether it is an operating lease or finance lease. The interest rate implicit is 10.78%. How should the lessor account for the same in its books, assuming it's a dealer lessor? IC has not written it, but it is implicitly assumed. So in case of a dealer lessor or in case of any other transaction, you will first have to figure out whether the transaction is an operating lease or a finance lease. So in the books of the lessor, you will first try to find the present value of minimum lease payments. So what are the minimum lease payments? It is 15,000 into the present value annuity factor at the rate of 10.078% for a period of 10 years plus the guaranteed residual value. The guaranteed residual value over here is 30,000. So if I do this working, I get 1,03,000. 1,03,000 compared with the fair value of 1,11,000. It is 93% and hence it substantially covers the fair value and hence it is a finance lease. Now if it is a finance lease, you will recognize the lease receivable at the net investment. Net investment is the present value of the lease payment plus even the present value of the unguaranteed residual value. If you total both of these, it comes to 1,11,000. So in case of a dealer lessor, you will recognize the lease receivable at 1,11,000. At the same time, you will de-recognize the asset from your books, which was at a carrying value of 1 lakh. So you will de-recognize the property or the asset at 1 lakh. But so ideally, the balancing figure you can show as the gain of 11,000. However, you will not show it directly because it is like a dealer. So you will have to show the sales and COGS. Sales over here will be recorded at fair value minus the unguaranteed residual value at present value terms, and correspondingly COGS will also be 1 lakh, which is the carrying value minus 7656. Implicitly, if you look at this entry, revenue will go to the P&L credit, sales will COGS will also go to the P&L, hence net 11,000 will be shown for a trader as sales minus COGS, that is a profit. Okay. Question number 3, the next question, which is on sale and lease back. Over here, there is an entity who is a seller lessee, sells a building to another entity for cash of 30 lakhs. So this is selling price 30 lakhs. Immediately before the transaction, building was carried at a cost of 15 lakhs. So this is like the WDV. At the same time, seller lessee enters into a contract with the buyer lessor for right of using the building for 20 years with an annual payment of 20 lakhs. Acha. So 2 lakhs payable at the end of each year for a period of 20 years. The terms show that the control is transferred. Basically, the next paragraph says the fair value of the building is 27 lakhs. Acha, what is the selling price? 30 lakhs. What is the fair value? 27 lakhs, which means the transaction is off market. So selling price minus fair value, which is equal to 3 lakhs. You are getting 3 lakhs more, and this 3 lakhs is treated as a hidden loan. Acha. Initial direct costs are to be ignored. The interest rate implicit is 12%. So the first part is find a hidden component. The hidden component is an off-market element of 3 lakhs, and hence 27 lakhs is attributable to the lease, 3 lakhs is attributable to the loan. Now, to the lease, we have agreed to pay 2 lakhs into the present value annuity factor at the rate of 12% for a period of 20 years. If I do the working, I will get 14,93,000. But a part of this 14,93,000 today is attributable to the loan, a part of it is attributable to lease. And as a result, out of the total payment of 14,93,000, we can say 3 lakhs is attributable to financing, that is the loan, and hence the remaining 11,93,000 is lease. Once you find 11,93,000, we are saying that in today's terms, you are agreeing to pay 11,93,000 for an asset which in today's terms is worth 27 lakhs. And hence, the fair value is 27, and this is the proportion of the rights that I am retaining. So my ROU asset, which in my books was appearing at 15 lakhs, I will retain 15 lakhs into the proportion that I am paying. 15 lakhs into 1193 upon 27 lakhs. This will appear as a part of my ROU asset. Now, if you have done till here, you can pass the journal entry. Whatever is a balancing figure will be shown as gain or loss. However, if you actually want to calculate gain or loss, we will find the gain. We will say that, okay, if 27 lakhs is the selling price, 15 lakhs, then 12 lakhs is the gain. Out of this 12 lakhs, a part of it is attributable to the rights which are retained, a part of it is attributable to the rights which are transferred. We will try to find a gain or loss attributable to the part of the rights which are transferred, and hence 12 lakhs into, we will say that out of 27 lakhs, you are retaining 11 lakh worth of rights. So 27 minus 11.93, if I do, जो भी number आता है, that will be the gain or loss if you want to calculate. So over here, this is proportion to the rights which are transferred. So you have taken the rights which are retained, balancing figure, and hence this will give you the journal entry in the books of the seller lessee. Okay, next you have question number 4, which involves remeasurement. So over here, W enters into a contract for lease of a retail store on 1st of January. The initial term is 5 years with a renewal option of 3 years. Achha, so this is 5 years initially with renewal of 3 years. The annual payments for initial term and renewal term are 1 lakh and 1,10,000 respectively. Okay, this is agreed, but we don't know whether renewal is going to happen. The annual lease payment will increase based on the annual increase in CPI at the end of the preceding year. For example, on 1st January 12 will be based on CPI on 31st December. W's incremental borrowing rate at inception and on 1st January is 5 and 6. So there are two rates and CPI is at two dates 120 and 125. At lease commencement, W did not have significant incentive to exercise the renewal option, which means the lease term would be taken as 5 years. You will not take the renewal option. In the first quarter of 2014, W installed unique lease improvements into the retail store with an estimated 5-year life. So now it determines it will recover the cost of improvements only if it exercises the renewal option, creating a significant economic incentive to extend. Is W required to measure the lease in the first quarter? So what you will first do is you will have to find the lease liability initially. So you will say initially, we believe that the lease term is, let us say, 5 years. In this case, since the lease payments are given in the example that the lease payment on 1st January is based on the CPI on 31st December, Institute over here has assumed that the lease payments are made at the start of the year. Now, usually lease payments can be assumed to be at the start or at the end. However, if there are data given in the question which gives you a hint that, for example, lease payments are at the start, for example, lease incentives are at the start, then you assume all payments are happening at the start. If nothing is given, you can assume either of these. So over here, if I try to find, let us say, the lease payments, I will have 1 lakh into the CPI at the beginning, that is 120 upon 120, and hence this will equal to 1 lakhs. So this is a payment at year 0, then year 1, 2, 3, 4. In each of these years, this is going to come to 1 lakhs. So the payment in each of these years is going to come at 1 lakh, and the discounting rate at the starting is at the rate of, I think, 5%. It later gets changed to 6%. Year 1, and then karke you will find a present value. So you will find the original lease liability to start with at 4,59,000. Now over 3 years, this lease liability will change and will come down to 1,95,233 on 31st March 13. Now this is a point where two things happen. There's a change in the estimate of you exercising the renewal. You now believe renewal will happen, and there is also a change in the CPI. So both of them happen. Because there is a change in the lease term, you will have to take the revised rate of 6%. If it was only CPI, you would have taken 5% only. So a revised lease liability will be based on the revised payment which you will have to make at 1 lakh into 125 by 120. Because the CPI is getting reset on 1st of January 2014. So you will take the revised CPI, that same payment in the next year. But now if you are also taking the renewal option, then that 1,10,000 will also come, which will also be adjusted for CPI, and hence the revised lease liability is 4,91,000. Compare that with the existing lease liability of 1,95,000, and the difference between the two will be credited to lease liability and debited to the ROU asset. So ROU asset to lease liability, the difference between 491 and 195, this is a remeasurement case. Acha. Then there is a modification. Remember, lease modification is something where there's a renegotiation. So in this case, lessee enters into a 10-year lease for 2,000 square feet or meters. The annual lease payments are 1 lakh, payable at the end of each year, and the interest rate implicit in the lease cannot be determined. It is basically 6%. So your original lease is for 2,000 square meters. It is 1 lakh payable at the end of each year at the rate of 6%. So if I do the present value, I will find the lease liability and the ROU asset at initial recognition. At the beginning of year 6, that is end of year 5, lessor and lessee agree to amend the original lease, okay, to include an additional 1,500 square meters from year 6. So there is an increase in scope and reduce the lease term from 10 years to 8 years. Achha, but out of this, 5 years have gone by, and hence 5 years were remaining. Now instead of 5 years, only 3 years are remaining. So this is basically decrease in the lease term. The annual fixed payment for 3,500 meters is 1,50,000 payable at the end of each year from year 6 to year 8, that is 3 years. And lessee's incremental rate is 7%. Achha, this part just tells you that you don't treat it as a separate lease. Achha, so how will you account for this? First of all, you will always in these cases find the lease liability as well as the right of use asset at the date of modification, at the date of initial, which is, let us say, 7,36,000. Then you find the lease liability and the ROU asset at the date of modification, which means over here you will prepare amortization table for 6 years, come to the lease liability at 4,21,000 and also ROU asset at 3,68,000. Now, whenever there is a derecognition, you will first have to proportionately derecognize the ROU asset and proportionately derecognize the lease liability. There were 5 years, out of which the last 2 years you don't have to pay 1 lakh anymore. And so lease liability 1 lakh in year 1, 1 lakh in year 2, 1 lakh in year 3, 1 lakh in year 4 and year 5. The 1 lakh in year 4 and 5 is not equivalent to 1 lakh in year 1 and 2, and hence you will have to find the present value of the amount that is getting derecognized over the last 2 years. You are saying that 1 lakh for these last 2 years is getting derecognized. So 1,53,925 will no longer be there. So you debit the lease liability by 1,53,000. But ROU asset is depreciated on a straight line basis. So if the last 2 years are not there, then 2 by 5 of your ROU asset will not be there. So 1,47,200, and hence your entry over here would be, if I were to pass this entry, it will be ROU asset. If you were to pass this entry, I'm not sure whether it is there, I think it is not printed. So your lease liability will be debited by 153,925. Your ROU asset will be derecognized by 147,200, and hence there will be a gain on derecognition as per ICI solution. I recommend you stick to that rather than deviating. Comes to 6,725. This will be a gain of 6,725. Now your revised lease liability will be at 2,67,300. However, there is an increase in scope, and hence your revised lease liability will be based on 1,50,000 over the remaining 3 years at the rate of 7%, which will be 3,93,000. And as a result, over here the difference between 2,67,000 and 3,93,000, that is 1,26,000, will be increase in ROU asset with the corresponding lease liability. Stick to the institute's versions over here. First you show the derecognition and the gain or loss on derecognition, and then you show an increase. There can be an alternative treatment, but it is preferable if you stick to the institute solutions here. Achha, then you have question number 6. This is separation of lease and non-lease components. So over here there is a lease agreement that is entered where the annual lease rental is 70,000 for an entire floor of mall. To carry out the operations, we have also agreed to take the facilities, and for the facilities we are paying 1 lakh. So the total consideration we are paying is 70,000 for the lease component, that is a floor, and 1 lakh for the services. However, this is as per agreement. You allocate the total 1,70,000 based on the standalone prices. The rate is 10%. The facilities agreement specifies that it is coexistent, that is fine. X assessed that the standalone price of the lease agreement is 1,20,000 and standalone price of the facilities is 80. Now your agreed transaction price is 70 plus 1 lakh, that is 1,70,000. However, this 1,70,000 will be attributable to the lease and the non-lease component in the ratio of the standalone prices, that is 1,70,000 into 120 by 200 and 1,70,000 into 80 by 200, that is in the ratio of standalone prices, and hence this number comes to, for example, 170 into, this is 102 and this is 170 into 68. So this comes to, let us say, 68. Okay, so you have to the entity has not decided to take the shortcut, so it wants to separate the lease and non-lease component. How will X account for the lease liability? Lease liability is the present value of the future lease payment, that is 1,02,000 discounted at the rate of 10%. So you will take 1,02,000 and discounted at the rate of 10% will give you the lease liability. So this is 1,02,000 discounted at the rate of 10% for a period of 9 years, and this will give you the lease liability. Achha, next you have question number 7. This is on foreign currency. This is very similar to the question on foreign exchange under IND AS 21 as well. X is an Indian entity whose functional currency is a rupee. It has taken a plant on lease for 5 years, for which it has to pay rentals of $10,000 each year. So over here, this is in dollars. On the commencement date, the exchange rate was 68. The average rate for year 1 was 69 and at the end of the year exchange rate is 70. Okay? 68, 69, 70, and the incremental borrowing rate on the commencement was 5% in USD. So you have to measure ROU asset and lease liability initially and at year 1. So initially, if I want to find the lease liability, I will take 10,000 into the PVAF at the rate of 5% for 5 years, which means I will get a particular lease liability in dollars. That will also be my ROU asset. My ROU asset is non-monetary. It will continue to remain at 68, but my lease liability is monetary and hence it will be remeasured. You will first start at 68, convert it into rupees, then you will take the effective interest first in dollars. Same working. Effective interest will first be taken into dollars, then minus coupon. So over here, let us say if I take 1 divided by 1.05, 1, 2, 3, 4, 5. So this is 4.3295. So this is 43,295. This is lease liability and ROU asset, 43,925 into 68. This is 29,86,900 will be your ROU asset and lease liability. Now ROU asset will be depreciated, divided by 5 every year, 5,97,380, nothing else. It is very simple. It is non-monetary, will not be remeasured. But lease liability in this case, your lease liability will initially be at 43,300 approximately, on which there will be an interest at 2165 and there will be a lease payment. So you will get everything in dollars and you will convert everything. This will be at 68. This will be converted. Lease payment is happening at the end 60. So this will be converted at 70. Interest is over the year 69 and the closing liability is monetary in nature and hence at 70. Exactly same as what you did for foreign exchange. Get it into rupees, and if there is a balancing figure comes, that is a balancing figure on lease liability, which is a monetary item which will be going into the profit and loss account. So over here there will be a foreign exchange gain or loss of 88,000 approximately, which will be taken in the profit and loss account, which is because it is a monetary item. Now this broadly takes care of lease. There is also CSR and there is integrated reporting and analysis of financial statements. Analysis of financial statements, there is nothing new, there is nothing to discuss. It is just a sum total of all the other questions which are there. So there is a lot of panic among students by analysis. You don't have to worry about that. Analysis, if you open once and see, the 3 or 4 new questions that were there in analysis are already there in your book. New questions meaning complicated questions. Other questions are just, instead of placing it and giving a topic section of practice questions, they have said analysis of financial statements. There is nothing else which you need to bother over there. In case of CSR and in case of integrated reporting, integrated reporting might come as theory. Over here, you just have to remember the 6 major forms of capital, where you have, I think, the financial capital, manufactured capital, human capital, social capital, natural capital, and intellectual capital. So these are the 6 forms of capital based on which some questions might come, primarily attributable to profit-making enterprise. It is voluntarily applicable in India to the top 500 listed companies as per SEBI. Nothing much. In case of CSR, the limits over here as per section 135 is to be applied on a standalone basis, separately for holding subsidiary companies, etc. So if your net profit is greater than or equal to 5 crores, if your net worth is greater than or equal to 200 crores, or if your turnover is greater than or equal to 1000 crores, then you will have to comply with CSR regulations, which involve setting up a CSR committee, which involve spending 2% of the average net profit of the immediately preceding 3 financial years on an average, and which involve you having to present a CSR report. While doing CSR compliances, you have to spend as per the terms given in Schedule 7. If you can contribute money into a CSR project, well and good. Otherwise, you will have to contribute to certain funds like Swachh Bharat Kosh or Prime Minister's Relief Fund, PM CARES funds, etc. In case of eligible CSR expenditures, you will have to ensure that expenses in the normal course or CSR activities or sales where commercial activities are done at a discount is not eligible CSR. You have to do something else. Payment to employees, not CSR. Political parties, not CSR. In a joint project, you have to have a clear allocation, joint project report. Money spent outside India, not CSR. As per guidance note, if the CSR obligation was 100 and you spent only 80, for the remaining 20 you create a provision. If the CSR obligation was 100, you spent 120, then for the excess you can now even show a prepaid CSR, because you can carry it forward up to 3 years if you want. Income earned on CSR projects cannot be used for your business, so there will be an obligation to spend that money. And Depreciation is not again treated as a CSR expenditure. CSR spending can be capital or revenue in nature. Again, you have to spend money, incur a liability. Merely announcing is not sufficient. So that is about CSR in this question. One of the questions, ABC is a company where net worth is 200 crores, manufacture rubber parts, sales of the companies are affected due to low demand, previous year's financials. For CSR, you don't look at the current year, you look at the immediately preceding year, and in the immediately preceding year, net profit is greater and hence CSR obligations apply. CSR committee is to be formed now only if your CSR spending is greater than 50 lakhs or in case of your CSR obligations, your CSR spending is greater than 50 lakhs or in certain other specified cases. But it is more of a legal angle. We don't have to go into that territory. So that is by and large about CSR and other topics. I guess we have kind of covered mostly a lot of these concepts. Have taken quite a bit of your time. I hope you have got slightly better understanding and you are in a good position to go ahead with the course. I'll end it for now, and if there's any other problems, any other issues, any other queries, please feel free to reach out to me. Wish you all the very best for your exams. Ensure that you use this time that you have to your best effort. You don't have to refer anything new particularly. If you think you are confident broadly, refer, consolidate your strengths. We have also shared a study plan. Try to refer that and cover everything. Ensure your FR paper you spend a lot of time before the FR paper. You spend some time in the time management. You ensure that you manage your time properly. 100 marks are 180 minutes, 1.8 minutes per mark, and ensure that you focus on completing the FR paper on a timely basis. Other than that, that should be it. We'll stop, and I hope this session was helpful. Do let me know your comments in the comments box, and study really hard, give it your best shot, and I'm sure you're going to do really well. Okay? Chalo. Thanks a lot and see you. I hope this session was helpful to you. Okay. Is it okay if we just cover the important questions? I would not recommend that. You have time for papers like SFM or other papers, yes, where you have limited time, preferable. FR is the first paper, you have sufficient time. So might as well do the questions, focus more on the important questions, on the adjustments, but kind of glance through the other questions as well. Okay? Chalo, I'll end the stream then.